Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy, coming to you straight from the precincts of the RBI, Mint Street as we call it. Well, it could be an also ran 25 basis rate cut policy, or it could be a policy of fireworks. We will know shortly in about 10-15 minutes. Joining me is Ritu Singh, my colleague from the Mumbai studios, and a bunch of guests. Ritu, over to you. Good morning. You did the poll, so tell us what the market's ready with.
Good morning, Lata. You know, the fireworks, if any, aren't likely to come from the rates, but it is the other policy measures that the street will really watch out for. 25 basis points rate cut, that's pretty much factored in. Anything above that, you know, there's a few outliers like Soumya from State Bank of India that are expecting a 50 basis point cut. Now, that is going to come as a big surprise if it does come at all. But of course, what the market will watch out for apart from this cut is the macro factors. Now, the GDP forecast for the current fiscal is at 6.5%. If there is a downward revision there or any risks cited from growth, that will give market cues about how RBI may look at rates going ahead. And importantly, the CPI forecast at 4% for the fiscal, the street actually has a number which is at least 50 basis points lower than that. So if they reduce that and that opens up room for further rate cuts, that's something we'll watch out for. The majority of our respondents are expecting a 10 to 20 basis points downward revision at the very least. Where will the terminal rates really grow? You know, the consensus is about 5.5 to 5.75%, and the rate cutting cycle is largely expected to end by December, although some are even betting on the end of rate cuts by August itself. Not much is expected on liquidity because, you know, RBI has already done a lot, and it's really the mandate of RBI more than the MPC, so we're not likely to hear much other than the fact that RBI will say we will keep adequate liquidity to direct to the real sectors of the economy. On non-policy measures, you know, anything on gold loans, given the government's recent comments, anything on the liquidity framework, including NBFCs, you know, some of it talking about in the external benchmark link rate, those are the things that we really look out for.
Oh, yes. Gold loan companies, of course, will have their ears pricked, their antenna up. Yeah, I mean, what about this foreign bank shareholding thing? Maybe he could electrify the atmosphere with something on that. But that, I guess, will be the press conference. Let me straight away introduce our guests. We have Nilesh Shah of Kotak, Parul Mittal Sinha of Standard Chartered, Indranil Pan, the chief economist from Yes Bank, and Sakshi Gupta, the economist from HDFC Bank. Ladies and gentlemen, it's an even house. Thank you very much for your time. Nilesh, let me start with you. What's the market expecting? What can be the outside surprise?
So whatever Ritu has summarized, that's the perfect summary. It just shows how predictable this monetary policy has become from a market point of view. Everything is under control, growth above estimate, inflation well within control, banking system fairly balanced on liquidity. So RBI will probably go as per the market expectation, 25 basis point rate cut, growth estimate probably keeping same at 6.5%. And inflation, while the actual number or the street number might be lower, they may just go ahead with 4% number to keep some buffer.
Okay. But a 50 bips cut could mean that you will sell off banks. I mean, there could be a trading sell on banks.
Undoubtedly, 50 basis point is going to have a material impact on banks' NIM margin. So there will be some sell-off if there is a 50 basis point rate cut in banking sector.
Okay, Parul Mittal Sinha, of course, would be the master at knowing what the bond market is thinking. Parul, what's the market prepared for? What will be the outside surprise? How may yields move if there is ultra dovishness or not so much?
Hi, Lata. So this time, market is pricing in exactly 25 basis points of rate cut for this MPC. And this we can see how the OIS curve is priced in. If we look at the bond curve, it's the shorter end of the curve is trading below the SDF rate itself. So 1-year T-bill is trading at 5.6%. So that tells us that apart from the rate cut expectations, there is a positive overhang from the liquidity surplus in the interbank market. So market has nothing to complain about over the last couple of months. Liquidity and the inflation coming down has really boosted markets' comfort on policy rate cuts. This is a very special policy where the fear is, what if RBI gives a bigger and bolder rate cut? And if that happens, I think market is not currently prepared for it. We can see material moves if that small probability of a larger rate cut materializes. And our governor has surprised the markets on the stronger action from RBI in the past. If we look at their policy on dollar rupee, on liquidity itself, the surplus which has been given is bigger than market participants anticipated. So very interesting policy, very finely priced in, exactly 25 basis points of rate cut expected, and a fear of a larger rate cut from RBI.
Yeah, there can be an argument made that the RBI wants the repo rate at 5.75, although the repo is today at 6. The call rate is at 5.75. So why not give a 50 bips cut and do reverse repo to keep the call rate at the repo rate? In that case, an argument for a 50 bips can be made, and continuous reverse repo to keep the call rate aligned to the repo rate. That argument can definitely be made. We will have to see what he would do about that. Indranil Pan, besides the 25 basis, what else would you watch?
I think for me, the very critical thing is, first of all, the base case is 25 basis points. I think the commentary for the future is very important for me. Now, the reason I say so is that there is no sort of grave fear on the growth. Yes, if I accept the potential growth rate for the economy at about, say, 6.5 to 7%, we are more or less there. And there is no grave fear that growth is sinking, which necessarily means that I don't expect a shock treatment from the Reserve Bank of India, even though inflation has surprised to the lower side. The critical thing I would be looking for also is how much they reduce their inflation expectations number. Now, the broad street expectation is about, say, a 10 to 20 basis points, which doesn't make a material difference to me. But for instance, the RBI sort of is bringing down the inflation forecast by about 50 basis points. That clearly is a signal for the forward guidance that the depth of the monetary policy easing can be significantly more. Now, the other reason why I don't expect a 50 is that we are reading newsprints that early rains may have damaged crops in the southern India. And there has been an uptick in prices of vegetables, especially tomato, which will probably be filtering into the market over the next 2 to 3 weeks. So that's also the reason, and given the various uncertainties from the global markets where inflation seems to have stalled and global rates being on the higher side, I would not sort of want the RBI to provide a 50 basis point shock.
All right, 50 basis points, a shock if it comes. Sakshi, are you at all pricing in any surprise apart from the 25 cut that is expected? And on the macro front, what sort of revisions, if any, are you expecting?
Right. Good morning. So, I broadly agree with what's been already said. I think 25 basis point rate cut is also my expectations. I don't think the RBI would want to rock the boat and deliver a 50 basis point cut. On inflation and growth, I think it is too early for them to kind of change or tinker with the forecast that we saw in April. And, given that food prices can be extremely notorious, in the months of, July and August, I think that they'll kind of keep that cushion. And for now, I would expect them to keep their inflation as well as growth forecast unchanged. I think it is too early for them to kind of revise down their inflation forecast. I think, one of the things that I would kind of watch out for is the tone of the monetary policy and their assessment of how domestic growth is doing, not just in terms of, any sort of impact from global headwinds, but how is the domestic recovery panning out, over the last couple of months. So their comfort around that, because I think that will give us some perspective on, what comes next. So are we looking at a further 25 basis point cut or a deeper rate cut cycle? So in terms of forward guidance, I think their commentary on growth will be very important.
Yep, I completely agree. We would watch out for 6.5 is where RBI stands. 6.3 to 6.8 is what the chief economic advisor has been saying for some time now. RBI is at the midpoint. Anything lower can mean that there is more dovishness. But Nilesh, what about outside the policy? What would you like to hear on gold loans? What would you like to hear on this, foreign bank shareholding that suddenly become very newsy? Even if he doesn't say anything in the statement, you can be rest assured that we are all going to ask him. So if he says, for instance, yes, we are reviewing, we don't mind a larger foreign bank shareholding, who gains? Will the chota private sector banks, old private sector banks become active, become interesting for you?
So undoubtedly, when a strong promoter steps into a banking system, investors will be positively looking towards it. Second, as this smaller guy gets bigger promoter, better promoter, their ability to compete with larger players also increases. And hence the entire banking system will have to be reevaluated. On the gold loan, whenever stock market goes up, we see beneficial impact in real estate sector. Far bigger wealth creation has happened on the gold. But unlike stock, where there's no emotional attachment to sell, on gold, for whatever reason, there's emotional attachment. I think if we can liberalize gold loan and ensure that this wealth effect translates through credit into other parts of economy, it will be better. Obviously, the gold loan, if done properly, is one of the most secured way of lending, and hence it can be pushed to create growth in economy. One more thing, Lata, we will be looking forward in this policy, if there is a hint, RBI is running a fairly large short forward dollar position. What will be the game plan over there? How will it get unwind? The reserves are comfortable. So how will that get unwind will be something we will be looking forward to in this policy.
Parul, very quickly, could there be any possibility of widening the corridor, reverting back to pre-pandemic levels of that 50 basis point gap between Repo and STF? Or you think this corridor is still serving its purpose?
So yes, there is a bit of discussion around whether RBI would want faster transmission and therefore widen the corridor so that the excess liquidity leads the banks to either lend at their SDF window 50 basis points lower than the repo rate, and that can then propel their propensity to extend credit and bring down the lending rates in the system. I think there are two choices in front of RBI. One, to either give a larger repo rate cut or to move the SDF window lower by another 25 basis points. I think given how RBI has been very focused on keeping the volatility in the overnight markets lower, I would personally give a higher probability to a deeper rate cut rather than widening of the corridor. I think RBI would continue to focus on keeping a control on the overnight rates closer and in the narrower corridor that has been their policy focus over the last few years.
Okay, so that's something that RBI is unlikely to do, at least in this policy. Quickly, Indranil Pan, non-policy measures, you think the liquidity framework, which has been under discussion with some of the bankers of late, is that something that RBI could discuss in this policy?
I would guess no, because as Parul also rightly mentioned, that they are not going to widen the corridor. So the liquidity measures are under discussion, and I think unless the sort of first document is placed for public discussion, I'm not sure whether the RBI governor will let out anything on the liquidity framework immediately in this policy.
Okay. Sakshi, what is your sense? Any other non-policy measures that you would watch out for?
Right. I mean, Ritu, at this stage, on the liquidity side, I also agree. I don't think that, we will hear too much around the, new liquidity framework. Also, in terms of, liquidity measures, the RBI has been already, very active on that front. System liquidity is now close to, a surplus of 2.9 lakh crores. I think they will talk about...
And Namaskar. The 55th meeting of the Monetary Policy Committee was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April, in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all 3 fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3 Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with the target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance. The fast-changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high-frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front-loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments continue to the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%. As I mentioned earlier, this is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion US, as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now, we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the the inflows, but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, $81 billion US. And so India continues, therefore, to be an attractive investment destination, despite there being a moderation, as we are seeing, in net inflows, which is primarily because of rise in repatriation, which is again which is a very good sign of a maturing market, where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at $691.5 billion US. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible, although we are aware and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system-level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system-level parameters of NBFCs are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines. And this is despite, the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power. It imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions. all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind.
Oh my God, this is a very startling policy. It means both a CRR cut and a repo cut of 50 basis points. So this is definitely an extremely pro-growth policy. And the last sentence that while we understand that inflation is our prime goal, we will not be oblivious to the importance to support growth during uncertain times. Clearly that statement is also extremely dovish. We perhaps are not seeing too much of a movement in yields simply because the rate cutting cycle seems to have ended for now. The policy has gone on to neutral, so we can't take further rate cuts for granted. That may be a bit of a negative, but I would think that it is positive. Banks, it's positive immediate fall in lending rates, and therefore, I mean, I would expect that the market is going to celebrate this in a decent fashion. Let me immediately get to our guests. We've got Sakshi, Upasana, and others with us, Rajiv Anand as well. Rajiv, first to you. Actually, what is the net impact if you've got a CRR cut, which liberates, you know, a 2.5 lakh crore on which you guys can earn anything from 6 to 7% by lending it? What is the impact on margins this year?
I think clearly, you know, like you rightly said, this is all about, you know, front-loading liquidity and rates to be able to get to a new trajectory of growth. And I think clearly in that context, the CRR cut is a huge positive. Our estimates and very early estimates, it would mean about 4 to 5 basis points positivity on NIMs at this point in time. One must also understand that you know, there is a cut, and so therefore margins as far as assets will reprice faster than deposits. But the CRR cut itself, if you look at it in isolation, would be about 4 to 5 basis points.
Yeah, immediately 4 to 5 basis points. But with the money multiplier going ahead, I think the benefit will be a little more. Of course, the 50 basis takes away from the margins, so you can't forego immediately. Let me come to the economists. Upasana, what have you made of this statement? Are you saying, will you now say that 5.5 it is and done?
Lata, the kind of surprises that we've got in this policy today, 50 here and 100 basis on the CRR cut, the stance has been shifted to neutral, and I think we should keep cognizant of that. We should, of course, you know, I think now what the governor has suggested is much of the rate action will be data dependent. There is a whole lot of uncertainty, global related, which he has referred to in his statement. And that will be the determining factor. If it has a spillover on growth, I think his last statement did refer to that while price stability is necessary, but not a sufficient condition for growth. So I guess he is open to action, but it also suggests, today's outcome suggests that the next two policies probably at least, to say the least, 2 to 3 policies suggest that on the repo rate front, only if we see a significant downside to his estimates of growth, we could expect some change, otherwise a pause in the near term.
So no action on definitely in August and October, you would say?
Yes, absolutely.
Okay. Sakshi, you agree?
Yeah, Lata, I mean, this policy was a big surprise. I think they've used the lower inflation and the space that they're getting from lower inflation to front load their rate cut. So, we had a terminal rate in this cycle of 5.5. And if we continue to see improvement in growth, I think that, at least for 2025 calendar year, we might not get any further rate cuts from the RBI.
Oh, okay. No further rate cuts this year. So your terminal rate is 5.5 now?
That's the terminal rate that we were working with. If growth comes in, broadly in line with what they are forecasting of 6.5, and we don't see a further, significant headwind from the global side, then I think that this could be very well the end of the rate cut cycle from the RBI.
Okay. Rajiv Anand, how quick will be the transmission of rates now that you all have slightly cheaper cost of funds overall because you can lend more of your money, 1 percentage point more of your deposits? How does the how does the transmission work?
Oh, I think as all of you know that on the asset side, a very large portion of the retail and SME portfolios are external benchmarking, typically repo rate, and so those will reprice anything from starting from tomorrow to within the quarter. However, it is what will take a little more time, obviously, is retail deposits. Typical maturity of retail deposits is 1 year, so you will see that book reprice over a period of 1 year. Obviously, there could be banks will perhaps once again look at cutting rates on the savings rate. You saw in the previous rate cut, banks were able to cut rates on savings accounts. That could perhaps happen again. So to answer your question, a very large portion of the asset side will reprice quickly. The retail deposits will reprice over the next 6 to 9 months, and you could see a cut in savings account rates very quickly.
Oh, that's big. That's important. Mr. Lakshmanan from Federal Bank is also with us. Mr. Lakshmanan, what is your sense in terms of the yields? I don't think there has been much of a movement in yields, but in the Reserve Bank, the connectivity is not very good. So I'm not quite sure of how the yields have moved. Would you say that you are expecting the fall in yields now to stop? I mean, yields going below 6 is now out of the question.
Yeah, so I think, of course, all of us have been caught in a bit of a surprise on the 550. If you saw the yield movement immediately after the announcement, it came down to closer to 610. It's back higher right now. In other words, I would say markets are pricing in a 550 terminal. And if you look at the OIS rates, if you look into the behavior of the 10-year after the announcement, it's pretty much talking about bulk of the rate cuts having been done. If, of course, the growth surprises further to the lower side compared to what the governor has spoken, then perhaps we would expect the market to readjust. But for now, I think a bit of a bottom seems to already be formed on the rate side, both on the GSEC as well as on the OIS at this point in time.
Okay. Well, Ritu, I believe you have more data now that the RBI has put out. How is the voting percentage? Have all of them supported 50 bips? Can you enlighten us a little more?
No, Lata, it is not a unanimous decision. Actually, 5 out of the MPC members, 5 voted for the 50 basis point outside surprising rate cut. Saugata Bhattacharya, though, he only voted for a 25 basis point rate cut. And the RBI has not really said much on how the voting went as far as the change of stance is concerned. If you remember in the last policy as well, the MPC did not vote on the change of stance to accommodate it. Perhaps this time around, it was something to that effect because, the voting pattern on the stance change has not been specified. But the rate cut, not unanimous. Saugata Bhattacharya actually voted for a 25 basis point reduction only.
Okay. No, I would agree with you. Actually, now I think it is set in stone. As long as Mr. Malhotra is in charge, the stance will not be put to vote. And actually, the Monetary Policy Act framework and the changes in the Act do not require the stance to be voted on. It is only the repo rate which is in the purview of the MPC. And it was just the generosity of Shaktikanta Das that he put the stance also to vote. but it's not called for by the Act. And Urjit Patel also did not put it to vote. So he's actually status quo ante on that. Mr. Lakshmanan, again, I wanted to also ask you about transmission. What is your best guess? Do you think you agree with what Rajiv said about transmission?
Yes. So the key to look at is with the 550 coming back, we are looking at a 525 as the SDF right now, which essentially means that the liquidity corridor clearly in the surplus liquidity environment that has been promised by RBI through the CRR as well, straight away comes in over there. And thus, to that extent, the transmission will need to get the savings rate as Rajiv was talking about coming in the same direction. So yes, so it clearly the effort, which is unsaid as a part of the policy announcement, is the focus on transmission and trying and front-loading the transmission on the earliest. It's been the prerogative, I think, and that's what has been emphasized in this decision.
Okay. Upasana, if I remember right, you all had a more benign view of the terminal repo rate. Do you change that? That is one question. And the other question is, now clearly the cost of funds, the cost of loans is going to fall rather fast for the borrower. So any changes, will you ameliorate your growth forecast a bit?
Lata, two things. Yes, we were at 5 to 5.25 on the terminal repo rate, and bulk of it was seen in FY26. So we were expecting to exit with this lower terminal rate in this year itself. The way I guess the uncertainties are, our GDP numbers are still at 6.2%, lower than what RBI expects, and risks are evenly balanced. Through the course of the year now, because today's policy decision comes not along with just 50 basis of rate cut, it comes along with the CRR cut. So as you said, the cost of borrowing is eventually going to transmit much more faster because of adequate liquidity. And that is the reason why there is a risk to our terminal rate being dropped to 5.25 now. Of course, 5.25 is the effective rate now, the way it stands. But having said that, there is clearly a risk. I think I would just say one thing, because now the decisions are going to be very data dependent. It is possible still that the terminal rate reaches 5.25, but that could be deferred into the next year. So it's going to be a more staggered way now.
Okay. No, I'm just wondering whether if he has given liquidity of a permanent nature, it's of course staggered, but 2.5 lakh crore, which means 70,000 crore comes right away, or 65,000 crores. What's your sense, Mr. Lakshmanan? Do you think he will not have to keep 1% of NDTL as surplus? He will not have to push the call rate to 25 basis below the repo. That may stop, do you think?
One,
he may start reverse repo.
Yeah, so the first 25 gets effective on the 6th of September is what has been stated. So to that extent, from a liquidity standpoint, the story remains the same for the next about 2 to 3 months. And I think the conversation, as I stated earlier, is give a direction to the overall liquidity position of the system more than anything else right now. So to that extent, from a liquidity corridor standpoint, at this stage, we have moved the call, which was perhaps in the 575, 580 mark right now, straight away about 40 basis points lower. And given the surplus liquidity that we see right now, take it to the sub 550 band. But are we saying that we're going to be jumping into the overall impact of 1% straight away? I think it is going to take a bit of time. Yes, the transmission with the 525 as the MSF, as the SDF, clearly gives the impetus for the rates to come in significantly lower, much faster than what would have happened otherwise.
I very strongly, I'm going to ask this question in the press conference. Whether now do you really need to keep the call rate 25 basis point below the repo rate? Do you really, or do you want to restart, reverse repo? VRRs hereafter would be my question. Rajiv, if you want to answer that. And secondly, more important, do you think loan growth, credit growth is going to be faster than you earlier thought, would you say?
And I think that is the key question. And I think both the MPC and the governor have been quite concerned about the fact that despite the fact that liquidity has significantly improved, pre 31st March, we have not seen any material change in terms of credit growth, whether it is on the retail side as well as on the wholesale side. And I think the key question to ask now is, given the fact that in general, lending rates are going to come down by, let us say, anything between 25 to 50 basis points, are we suddenly going to see a surge in credit growth? I think that is really the moot point at this point. And the other way to perhaps think of it, and to put out a cautionary note, the fact that RBI has cut rates by 50 basis points, they've cut CRR, and we're going to see adequate or more than adequate liquidity in the system. Does that indicate or signal that they are a bit concerned about growth as we go forward? And so therefore, they have decided to, front load significantly more than what the market expectations were.
Yeah, he clearly said that in his, what was his last sentence? That we are aware that inflation is our, mandate, but we are not oblivious to the fact that there are uncertainties around growth, and we will have to push it therefore. So I think he said it, he did not shy away from it. Sakshi, would you therefore, pencil in a higher growth? Would you push up your own forecast because you see higher credit growth? Because you see an RBI which says that I am all out to stimulate growth.
Right, Lata, I don't think at this stage I'm looking at revising up the GDP growth forecast. We are at 6.3 for the year, right? I think we have to remember a couple of things. One, monetary policy, of course, works with a lag. Secondly, while, the RBI is trying to address the supply of money in the system by doing all these, durable liquidity injections, I think demand for credit also has to kind of, pick up, right? And that is a function of how consumer demand is doing and income growth is doing in the economy and so many other factors. So I think at this stage, I think it is too early for me to think of revising up the forecast. Although I think with this front loading of the monetary policy, stimulus, both in terms of rate cuts as well as liquidity, it does give me some optimism or a little bit upside to my forecast going forward. But at this stage, I would keep it unchanged.
All right, all the surprising big rate cut and the big CRR cut, that of course is getting all of our attention. But I think one of the big deviations in this policy that we're seeing is really no comments from the governor on other non-policy measures. Usually you'd have some of the norms tweaks, something related to UPI, so on and so forth. Not a word of that. I'm wondering, I've been refreshing the RBI website as well, and I don't see any other measures that the market was expecting. But, Rajiv, if I could ask you this, the only comment sort of for the banking system that we saw from the governor was that the stress in unsecured loans and credit card has abated. Do you take that as a cue that perhaps the Reserve Bank of India may look at lowering or rather reverting the risk weights, the higher risk weights for the segment?
Absolutely, Ritu. I was, given the fact that they have already done so much, rate cuts and liquidity, I would have liked them to reduce risk weights on unsecured loans, and I think that would have perhaps signaled to banks as well to indicate to them that RBI is a lot more comfortable as far as unsecured loan growth is concerned, and so therefore banks could potentially push that. So yes, will it come post the policy? One will have to wait and watch.
Yeah, absolutely. I mean, again, there is nothing yet on the RBI website on any other measures that were to be announced. And perhaps in the Q&A, we'll hear more on the foreign bank holding and so on and so forth. Upasana, quickly, do you expect now this pause to continue for the remaining part of the year? Just give us a, understanding of, you've given us your terminal repo rate. But, when is the next likely move?
At this point, I would say in the near term, I can only foresee a pause. Honestly, they have front-loaded a lot of their actions, and CRR cut was definitely not a part of this base case of ours. So I think this liquidity plus a repo rate cut, which is much more aggressive, does suggest that there is a need to pause for sure, at least over the next 2 to 3 policies, I would say, that would also give a window to evaluate the risks on growth either direction. Like, for example, even the RBI is expecting 6.5 with balance of risks on either side. I would say that there's a lot of uncertainty on the global front, how the investment environment is going to pan out. And that still poses some risks on the growth front. How much of that time will only tell. So in all of this, I guess that was probably the reason behind such kind of front-loaded action by RBI. And hence, for the time being, I would expect as a pause in the near term.
Okay. Okay. Well, just to add to Ritu's questions, Upasana, you're also not raising your growth forecast?
Not at the moment.
Okay. No, I can imagine there are too many uncertainties, but this is a damn vigorous attempt by the Reserve Bank and the MPC to spur growth. I'm actually missing Soumya Kanti Ghosh in this conversation. He was the only one in our Citizens MPC who voted for a 50 bips rate cut, and in some stray conversations had also mentioned CRR cut. Rajiv Anand, actually, do you think that the governor will even stop at 3%? See, all these CRR cuts, etc., were set at a time when public sector banks ruled the roost, and that was the only way Indians saved. Now the whole structure of banking has gone into a huge change, and banking is not that languid banking that we could bank on in the 90s. So, I mean, is there even more, or 3 it is and done? Legally, he can't go below 3. The law needs a change.
Exactly. And I think, ultimately CRR is a liquidity tool. You yourself mentioned this many times, that this is sustainable, long-term, durable liquidity that has been infused into the system, and gives the banks the ability to increase lending on the other side. And I think, they've looked at this as a total package, CRR cut, liquidity, and the rate cuts. And as the economists on this panel have said, it looks like they front-loaded everything, and basically indicating to the market, don't expect very much more, at least for the next couple of meetings, unless the world changes dramatically.
Okay, very quickly, I know you will have to go back to your ALCO and your CEO and all that, but broadly, you think most banks may be upping their credit growth forecast this year, Rajiv? No?
As I currently stand today, that looks unlikely. I'm not seeing the impetus at this point in time. Like I mentioned, overall system liquidity growth is around 10%. I don't think we are seeing impetus yet to believe that over the next 6 to 9 months, this number is going to go up, even let us say 200 basis points.
Okay. Lakshmanan, if you have a thought on credit growth, that, and the other question to you is, now what is your range for the 10-year? What is the market telling you? What are the OISs telling you, even of the shorter term rates?
Yeah, so the first question, yes, credit growth. I think we've seen if you look at the banking system growth on the balance sheet, it has been on a downward trajectory. A lot will depend, of course, not only in terms of the monetary action that's happened today, but overall in terms of the consumer demand, the overall spending intent of corporates per se, given the cost of liquidity as we're talking about it, and of course a whole lot of situation across the border in terms of what's happening in the US. A lot of that is going to be driving in terms of how the companies are going to be spending, how the customers are going to be having a nature for demand. So we still have to wait out and watch as to how the credit growth will happen. So I don't think the algos, in my view, are going to rush into increase the credit growth just because of this. It is still going to be wait and watch in terms of how various parts of the economy are faring. In terms of the rates for GSEC, I think, in a way, a 6-10 move that has happened perhaps has hit in the bottom at this particular point in time. The 1 year, the 5 year OIs are in a way speaking that 550 to a 5-quarter kind of a terminal is what is there right now. So I'm not in favor of talking about a 10-year immediately going lower because of 50 pp cut that has happened and the liquidity infusion. In fact, the key thing to note is also the fact that the stance has been brought into a neutral right now. So given all of that, at this stage, I'm not calling for the 10-year going in significantly lower from perhaps the 6.5, 6.10 that was seen today.
Sakshi and Upasana, both of you, I just quickly wanted your comments. Sakshi, starting with you. Given all of this, in summary, what are the comments, what are the questions you'd want to hear answered from the governor in the press conference that will start at 12? Sakshi, with you first.
Yeah, so Ritu, I think we've discussed a couple of issues already. I think one of the things that, I would be interested in knowing is within the liquidity, injection that the RBI is doing, and the governor spoke a lot about our external sector, FDI, FII, the FX reserve position. Where does the is there any thinking at the RBI in terms of its short, forward dollar book? Because, ultimately, if they're going to let that mature, that is negative liquidity, right? So I think just some perspectives around that is something that I would be interested in knowing.
Okay. No, everybody wants to know about what are you going to do with your short dollar positions. But they have managed from what a load it was. Was it, 80 billion or something? I mean, they've managed it well. So I would give them a lot of credit. Of course, you can't rule out some kind of a swap because of that. Some very, very long-term swaps. Digant Haria has joined us to give us an idea of how bank stocks should be approached now. Incidentally, the Bank Nifty is the best performing index now, and no prizes for guessing why. That unexpected whopping 1%. Shaktikanta gave only 50 basis CRR cut. Malhotra has given 100 basis points CRR cut. Digant Haria, do banks become attractive now? Will the margin crunch be less on a full year basis, even if it is a large crunch in the immediate quarter?
Yeah, morning, Lata. See, I think this rate cut and this liquidity infusion, it tells us one thing that, somehow the growth is not picking up. The economy has been slow. So, while it is a reason to celebrate, it is also an acknowledgement that growth is not as per, what the RBI is expecting or what, our country's potential is, especially if we see the consumption sector, the auto sector, or even the real estate sector slowed down. So I think this is a step in that direction. And see, banks, as we all know, right, that initially 1 or 2 quarters is something where they suffer because of these rate cuts, because the customers are expecting that some of these rate cuts will be passed on immediately. And the deposit rates are slow to respond. even the rate cut which happened 2 months back, the deposit rates did not move down as fast as the loan rates. So I think another 3 months, another 3 to 6 months of margin pressures for banks is there. We just want that, the growth has to recover. The system growth is at 9% currently, the loan growth for the system. That has to go to 12-13% because that is where our equilibrium is. The global macros are good. Now the domestic macros will significantly improve after this. So I'm very hopeful that, after monsoons, we will see, good demand pick up. Banking stocks can do well. But again, in large cap banks, you are very careful because there's not much upside. But there are a lot of these weak liability franchise. That's our hunting ground, Lata.
Okay. Well, actually, on a extraneous point of view, one of the reasons why the loan growth is a little lower for the system is that the second largest bank is in a wanton low loan growth mode. But for FY26, their guidance is that they will grow as much as the system. So perhaps even that would be a push in terms of higher than the 9% loan growth that we now see. Digant, I mean, what stocks should one go for now? Since the cost of credit for the borrower has come down more than we thought, so would you go for real estate stocks? Would you go for NBFC stocks? Would you go for the usual borrower stocks?
Yeah, so Lata, firstly, I think the weak liability franchise stocks, the stocks like, say, an IndusInd Bank, an IDFC Bank, or a RBL Bank, and, all these small finance banks, the Equitas, Ujjivan, and Jana Finance banks, I think they are the ones who suffered big brunt of the tight deposit and liquidity environment for the last 12 months. I think they will see a good reversal, not just in growth, but, even in margins and the asset quality. So I think that is where the biggest data in terms of earnings is. So we'll focus on, not the top 8-9 large banks, but the banks which are below that, which suffered over the last year. That should be the first basket one can look at. The second basket will obviously be the interest rate sensitive, the real estate stocks, not the luxury ones like Oberoi, because luxury is indifferent to real estate. But, at least somebody who is selling in that 50 lakh to 2 crore kind of ticket size, those real estate stocks. And auto stocks are also somewhat interest rate sensitive. So, something like, car stocks, car stocks will. And then we also saw that budget, where consumers were given some bonanza. So I think combine all of this, we should be seeing very good festive season this time. At least that's our hope. So these three baskets is very focused for stock ideas.
Real estate and auto, of course, the first thing that comes to mind. But Rajiv, let me quickly ask you, in this rate cut cycle so far, what we've seen is a faster repricing of deposits. Then they've already come down by as much as 70 basis points for some banks. Is there scope for further reduction to protect NIMs as your external benchmark-linked lending rates come down?
Oh, absolutely. Ritu, what you've seen is that if you look at the liability stack, the institutional portion has repriced faster. CDs have dropped, from close to 8% to 6.25%-ish, and they'll continue to fall. Similarly, non-retail term deposits have repriced very, very quickly. The stickier portion really is retail term deposits. There is a stock and there is a flow. Obviously, flow has already repriced and will continue to reprice. But I think it's as far as the flow is concerned, as far as the stock is concerned, it will take over the next 6 to 9 months for it to reprice. And I think one of the things that we've seen, like I mentioned earlier as well, one of the things that we saw earlier in the year is that banks have been able to reprice savings account rates. I do believe that we will see one more cycle of that as well, particularly among the larger banks.
All right, running out of time. Upasana, quickly, let me complete that question. What would you want to hear from the governor in the press conference?
So I think one important part is now that we have shifted the stance back to neutral. Does that, and there are two things basically. Liquidity has been provided in ample, and stance has been shifted to neutral. So do the overnight rates, will they be anchoring closer to repo rate, or there is still going to be effective easing with overnight rates still continuing to, hover around the SDF rate? So basically overnight VRRs can be introduced to ensure that at least, we do see some kind of an uptick and rates not falling really below the lower end of the corridor. So this is something which should be, I think, provided for as clarity. Maybe we'll have to wait for the new LAF framework, the liquidity framework, for such clarity. But yes, I think that is one important aspect. I just want to highlight one more point. Since we've talked about the forward outstanding, the CRR durable liquidity which is being provided for, which is going to be spread in 4 tranches, I think this could be an offsetter to the redemptions that will be happening on the forward book. So this could actually neutralize the book that is existing at this point. And as a result, in the second half of the year, wherein there was scope for additional monetary liquidity easing measures, that could be nullified now.
All right, those are important comments to take note of, but unfortunately we're completely out of time. Sakshi, Upasana, Rajiv, Lakshmanan and Digant, thank you so much for helping us pass through this very important policy, taken us all by surprise, that 50 basis point rate cut and a 100 basis point CRR cut, along with a change in stance to neutral. All of you, thanks very much for your time here. I'll toss it right back to Lata for her closing comments.
Well, it is clearly a policy that has made us sit up. There is no denying that there is a fundamental shift in the way we have to approach banks as investors. The Reserve Bank is telling us that the days of easy banking are over, and therefore, squeezing out the banks with larger requirements, prudential requirements, should also be brought down. Give banks a fair chance to play as commercial players. That seems to be one of the thoughts. Of course, there is the growth angle, there is a macro angle, but I'm also saying that there is a banking regulator angle over here and a banking development angle over here. The second big point is that, at the moment, the governor has gone, or the RBI has gone all out to stimulate growth, which can mean two things. That if the global environment is not as horribly challenging as it had been on April the 2nd, then probably we have a better chance for credit growth and growth. But on the other hand, does the Reserve Bank know a thing or two about growth? Is it getting a feeling that growth is severely challenged, and that is why it has gone all out? There is that double-edged sword in terms of how you have to look at it. But for the moment, the stock markets are celebrating, and the anticipation is that borrowing companies like, autos, real estate, NBFCs are going to have a good time, at least in the near future. The worry will really be for the bond dealers, where, the expectation was that the yields will go below 6% because there was a goodish bit of a 5% expectation of rate cut. By going to neutral and by almost hinting a kind of a pause in the near to the medium term, the yield, the rally in the bond market has kind of will plateau for the moment. But there are lots of questions to ask the governor in terms of how they will handle liquidity on a day-to-day basis. On that note, once again, thanks to all my guests and from Ritu and me. Thank you very much for watching this special show. After a break, it's time for HTR Halftime Report.
Hello and welcome to Trading Hour. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Rima. With me is Hormuz Fatakia. And the RBI has fired the monetary bazooka, slashed interest rates by 50 basis points, shifted the stance to neutral, and this bigger than expected easing has lifted the market moves as India perhaps is getting, according to the RBI, getting ready for this pro-growth stance. Benchmark indices up close to about 0.9%, the Nifty inching towards that 25,000 mark. The only question now is, as everyone's been pointing, what next, right? What's left in terms of a trigger? And RBI, the governor himself acknowledged that the MPC felt it is now left with very limited space to support growth. So it seems like all the good news, at least from the monetary policy side, for now is in the price.
What a roller coaster policy it was, right? If you look at that intraday chart of the Nifty, before the rate decision came, it was at the lows of the day, and then that 50 bips rate cut comes, and then the RBI governor's comments on very little policy room, and then you were being in a bit of a sluggish move, and then comes that big CRR cut that was announced, and since then the index has been in one-way traffic, of course predominantly led by the Nifty Bank, which is at a record high as of now. The Nifty 2 is heading towards that 25,000 mark, now a mark that it has managed to close above but not sustain at those levels. And the Nifty Bank now at 56,500 is where it stands, an almost 900 point recovery from the lows of the day. So it is a very, very strong move in the banking names. And of course, It is the NBFCs, the banks. IDFC First is up 5.5%, and Godrej Properties, real estate names too. Godrej Properties is up 5%, DLF up 4%, Oberoi Realty up 4% as well. And of course, the comments coming in on the unsecured space as well from the RBI Governor has led to these credit card names doing well for themselves, be it SBI Cards, be it the likes of PNB Housing Finance, Shriram Finance, all of these NBFCs, and look at SBI Cards too at the highs of the day. So it is the banks and the NBFCs that have had a big up move, and that has contributed to the moves on the Nifty as well. Now, Ajay Srivastava, who is the CEO at Dimensions Corporate Finance Services, is joining us now. Ajay, good morning. Thank you for joining in. What do you make of this absolutely roller coaster policy? First the 50 bips surprise, then comes the CRR surprise. What does that do now to all these banking, real estate names?
Well, it's doing what's supposed to do. I think it's done already what's supposed to do is to take them up, because I think it's a brilliant move. It's a brilliant move because this is one RBI governor who knows what's happening on the street. And what's happening on the street was slackening demand, consumer demand was at historic lows, the stores were empty, the real estate was feeling the pinch as well after a bumper year. And he knew he had to do something to get the spirits up. And I think he's done what he has to. And I think I love the guy. He just went all in. He didn't go and saying 25, 50, and this kind of stuff. He just went all in and said, guys, here are my chips. Now I've dealt with all to you. Now it's up to the finance ministry now. Nothing more I can do. And I think the response has been tremendous in the market as well, because it's not only the fact that the rate reduction, it's the fact that the RBI is conscious of what's happening in the real economy and responding to it. I think that's the chief signaling one takes away is he's noticing demands fall, he's seeing consumer sentiment is down there, and he gives a bumper to say, okay, I'm going to give you some more money to your pocket, your EMI is going to go down. So I think it's more than just the policy gesture. I think it's also the response to what's happening on the field in the economy. That's a great positive coming from the move, and I think we should look at it positively to the manner that more should follow from finance ministry now on the GST side. I mean, that's the last leg left to get this economy up and going, because the demand is slow in the market.
Given that the RBI has done whatever it could, we've seen cumulative rate cuts of about 100 basis points, everything that the market would have hoped for, perhaps even 6 months later. Are you surprised with the kind of reaction? Would you have anticipated that with this kind of a policy, markets would have moved up more? And what is that telling you?
No, more, we behave like Oliver Twist. Can we have some more? Okay, yeah, we can have some more. We can have some more rate cut. We can have some more market going up and all. And nothing going to finish in one day. The market will carry on tomorrow, digest the news, see, it's also a reflection. It's a very important reflection in that the demand is slow. The loan growth demand is slow. People are not buying products, whether it's two-wheeler, whether it's consumer staple, whether it's apparels. And therefore, this is a response to a demand slowdown. So it's not like it's going to be gangbusters tomorrow morning. The demand will start to shoot up because EMI has gone down. So the market is smart. It knows the reality of demand will not change overnight. Yes, it gives an impetus to people with lower EMIs to spend more. I think that's what it does to this policy. And those rates will come down over time, etc. But therefore, market is fully cognizant that we are operating in a low demand scenario. So don't get carried away with what we are doing in terms of that this will open up some great growth of this thing. The growth forecast is still 6.5. It's not changed in the RBI stance. And I think lower inflation also reflects in an economy like ours, the demand slowdown. So, yes, you can expect market to have gone up by 3% or 4%, but the fact is we are all cognizant that the April, May, June results will not be the best result for most companies, and therefore temper down expectations, react to it. A lot of it is short covering also in the market. Market was heavily short at this point of time. So a lot of it is short covering more than investment buying. So one has to temper down and say, good day. At the end of the day, we all end well. I think that's a good part. But signaling is more important, that RBI is willing to act. And I think we can take some comfort from that.
Promise less, deliver more is what would the street be expecting, right, when it comes to these companies going forward. But Ajay, does this mean that these larger private financials, the private banking, the giants, the HDFCs and the ICICIs, would they be the better placed ones now to put your money to work in, considering these cuts that have happened, and now will be better placed to increase their loan growth, to increase their growth in general as well? So does this large scale private financial names, which has been a general consensus of the street as well, right, does that now become a more attractive opportunity than what it was?
Oh, it does, because two things happen. One, of course, is that the capital requirement goes down because the CRR releasing money, they don't need to, get more capital in. So capital dilution gets postponed. That's the biggest thing happens in a bank. The moment you expand, you need more capital apart from profit. So you keep diluting your shares. So I think this is important for the CRR cut, particularly is important from the perspective they have more liquidity to lend. They don't need to necessarily go raise capital and then raise debt and then lend to the market. So one big important factor is that they will now have postponement of capital dilution. So obviously it becomes a good story for all of us to buy into. But having said that, more important thing to realize is that banking as a sector always underperforms the real economy. So when you're investing and allocating capital, yes, HDFC Bank may go up or X, Y, and Bank may go up. But remember this always that real economy will give you better returns in India than the banking sector. It's true for the last 5 years. It will remain true for the next 5 years because banking is a heavily competitive sector, unlike most economy sectors where we have duopolies or reasonably strong companies with good margins. So you got to be careful to allocate capital to say, don't get carried away with financials because for a financial company to grow, the real economy has to grow first.
What about real estate? Do you see, at least at the lower end, buyers coming back with these cumulative rate cuts?
Oh, yes. I think it's a great relief. It's a great relief because people who had bought the properties were not been able to pay. Most of them were having trouble paying up the property rates. And therefore, it's a big relief to them that the EMIs would drop and they can buy more because the real estate price has also gone up. So I think it's a great relief for real estate buyers per se. They should come and buy it. Unfortunately, all the listed companies cater to the luxury space, which is not necessarily kind of affected so much by the loan interest. So I'm not sure there's a direct correlation for most listed companies, Rima. But the fact is, generally speaking, a lower EMI results in a positive outlook towards real estate, generally speaking. So I think it's a good move for all the real estate companies, although most of them sell to super luxury market for whom EMI rates make really no difference.
Ajay, now that the policy has been hogging the limelight, the other two sectors that have been hogging the limelight aside of the policy, one has been defense, the other has been railways. Stocks going up 80-100% in a month. Defense has had triggers, but that is also on a very, very long-term basis that their order inflows coming in. The executions will happen over a 3-4 year period. But stocks have gone up and they've gone up exponentially. Same is the case for railways. And despite the fact that they are still down almost 30-40%, these railway names, you still find them expensive?
Of course they're expensive. They're crazily expensive. But yes, a couple of companies had a lackluster 1 year or 2 years, which happens, but they're good quality companies for long-term growth. So, just to look at a perspective from a 1 year performance, I don't think it's fair to some of the companies. But having said that, any sector which is dependent on the government for the order book needs to be approached with great amount of caution to say, yes, these ride up because so much of liquidity goes to such a, how many defense names we're talking about listed? 5, 7 private listed? That's all the stocks in India are. And then there's the PSU bunch of 4 stocks. So, so there is a lot of money now chasing these 6 stocks. It happened, remember, almost 6 months back. This went crazily up. And then what happened? Every mutual fund came with a defense scheme, and I think 1 or 2 mutual funds have barely made it to the break-even point after 8 months or 1 year defense. I'm talking of defense-focused mutual fund. So it's a flavor of the season, and as you say, in the flavor you enjoy it, but learn when to get off and book your profit because it will not continue. The expectation of demand is such, valuation-wise is so high. It's not going to be satisfied at the end of the day. So yes, ride the tiger, ride the trend. But the fact is, when the music stops, it will stop every 6 months. When realization comes, orders are not coming. Are you going to be sitting on a chair? Or are you going to be standing, waiting out in the mirror? That's the question to yourself.
Enjoy it till it lasts, as they say. Ajay, pleasure having you as always. Thank you so much for sparing time and joining us today. But to take this conversation forward on the RBI policy, we are being joined now by Mr. V. Vaidyanathan, the MD and CEO of IDFC First Bank. And Ritu is good here to take this conversation forward. Ritu.
Thank you so much, Harmaz and Rima. And Mr. Vaidyanathan, thank you so much for joining us here on CNBC TV 18. Big surprise from the policy, that 50 basis point cut and the 100 basis point CRR cut and the change in stance, of course. First thoughts, what did you make of it and what does it mean for NBFCs like you?
Well, for everybody in the system, whether banks or NBFCs, it's pretty clear that RBI is doing everything they can to support growth. They can see the inflation trending down. So they have seen the data and accordingly taken this decision. and that's obviously going to, in our sense, will support growth.
Well, it will support growth, but tell us, Mr. Vaidyanathan, immediately the first thing that happens when we see a rate cut from RBI, of course, your external benchmark-linked lending rates for banks will go down. What happens to margins? What are the levers to protect it?
Well, I can share our own sense on this front, and maybe our representative was one of the representatives, I'd say, that in our case, about 30% of our book is repo linked. So a 50 basis points cut will give a 15 basis point reduction on that front. About 10% of our book is MCLR linked. Let's call it a couple of basis points there. And because the CRR cut will improve the NIM by about 5 or 6 basis points. So let me say on the existing book, all put together about maybe a 12 basis points on the reduction.
Only 30% of your book is linked to the external benchmark, Mr. Vaidyanathan?
Yeah, to the repo, yes, only 30%.
Okay, in that case, you see a limited downside, and on the liabilities front as well. We've seen in the rate cutting cycle so far, liabilities getting repriced faster. They've already come down by about 30 to 70 basis points for banks. Is there scope for further reduction from here on?
Yes, indeed it should. In fact, this morning anyway, we made certain cuts in our deposit rates. So on the fixed deposit rate front, we have dropped our interest rate straight down to 7%. We were paying about 7.8 to 7.9% maybe until a few months ago. So 7% meaning there is a particular bucket which is really representative because that's the peak bucket. Let me say we've taken a peak bucket down to 7%. So that's a reduction we have done. We have done some reduction on the savings front also. So maybe after this rate cut, we'll have to cut this further.
All right. That's interesting to hear. But coming back to that very surprising, large, permanent liquidity injection in the form of the CRR cut. And now that starts from the 6th of September and it'll be in equal tranches. So assume about 62,500 crores of liquidity coming into the system starting September. How much additional credit could this unlock, Mr. Vaidyanathan? How will your own credit growth number for the year go up on the back of this additional liquidity that the bank gets?
Well, you know that credit has been quite tepid earlier. A couple of years ago, it was growing by 15, 16%. It's now people are talking of 10, 11%. It's been let me say, a significant slowdown on credit. This will definitely, without a doubt, support credit because, EMIs will come down. That amount of EMI coming down will leave that much more cash in people's hands. And this is a substantial cut. You can see CRR coming down and Repo coming down by 50 on the back of a reduction already done in the last couple of months. So EMI should come down. That leaves the extra cash in people's hands. And that should, no doubt about it, should support growth. And at least we can clearly see that, really RBI is doing everything they can. I have a sense that this, maybe it comes with a lag, but it will look up. And to your previous question on the NIMs, just to be clear on the record on what we expect, I read out. I know I said some numbers to you, but the impact on NIM will be a little more pronounced initially because the rate cut is immediate and customers get the benefit immediately. And the deposit rate reduction, when the FD fixed deposit reprice, it takes about maybe 5 or 6, 7 months, 1 year to reprice. So the catch up on NIM, let me say the reduction on NIM that will happen the first 2 quarters, let me say by third quarter, fourth quarter, should normalize again. But, we're running a bank for the long run. These small cycles, 1 or 2 quarters, we should be able to take.
Well, interesting that by the third quarter, you expect any sort of hit that the NIM will take for IDFC First Bank to be reversed once the liabilities also, catch up with the lag.
But start catching up, so to say.
Yeah. Well, Mr. Vaidyanathan, you did say credit growth is expected to be higher on the back of the CRR cut, but to what extent?
Well, I was talking for the system, for our bank, we have a plan. We're working to a plan. We'll watch this very carefully. Of course, if the market is more buoyant, naturally we'll participate in it. And, but our main thing is that we will want to keep credit quality really in good control. And that is our prime focus. And we will stay to a broad plan about how we want to grow credit and we'll watch out for the opportunities.
All right. So, but no numbers that you're sharing with us yet. We'll get back to that. But Mr. Vaidyanathan, another interesting comment that came in from the RBI governor was on the fact that unsecured loans, credit card loans, it seems that the stress has abated. I mean, is that the sense you're getting as well? And also, on the back of this, are you expecting RBI to revert to the lower risk weights?
Well, on the unsecured front, we have always been saying that unsecured is a cash flow driven lending, and cash flow driven lending on unsecured also behaves almost as good as secured, because cash is also security, and being able to debit a customer's bank account on the due date, having seen cash, is as good as an escrow. To that extent, it does give comfort. But RBI has been watching this for a time. They have always asked us to be cautious and asked everyone to be cautious. I think the fact that they of course have a big vantage point to see, and at their vantage point, if they're seeing it, then it's more encouraging. Of course, they also pointed out that MFI stress has exactly not gone away for the whole system. So all in all put together, I mean, it's hard to say whether they will look at the risk weights again, but maybe they will watch it for some more time. Maybe they'll watch it for 6 more months, 9 more months. At some point of time, if they get more comfort, maybe they will.
All right. Well, RBI does have a bigger picture and a view of all of the banks and NBFC's balance sheets. So yes, Mr. Vaidyanathan, finally, as a banker, is there some clarity you would seek from the RBI governor we should watch out for in the press conference?
I think the picture that they're putting out is quite clear, that they see they'd like to see growth and they'd like to support growth. So I think that maybe, of course, this has to be seen in the context of what the government of India does, because government of also kept fiscal under good control. So it's not exactly a question, but it's just a remark that this whole movement has to be seen in the context of what government also does. And I think the really good news here is that I'm seeing that the RBI is doing its bit. After, as you know, RBI is very thoughtful and they really look long. But while they've done what they've done, apart from that, I think probably they're working very closely with the regulator. With the government. Looks to be a coordinated effort. So not really a question, but I'd just say that looks like everybody's aligned towards a broad direction of keeping stability and growth.
Well, yes, and RBI has clearly gone all out in support of that. Mr. Vaidyanathan, always a pleasure. Thanks so much for your time here on CNBC TV 18.
Thank you very much.
Thanks a lot for that, Ritu, for that interesting conversation there with the management of IDFC First Bank. By the way, the index now at 24,965, still finding a bit of resistance at that 25,000 mark, despite this very, very strong policy from the Reserve Bank of India. The Sensex to 650 points higher. The Nifty Bank, though, continuing to trade at a new record high. Take a short break. On the other side, all things commodities with Manisha Gupta. Welcome back. Shifting focus now to the commodity space. Manisha is here with us. And today what's glittering is silver and not gold, Manisha.
Absolutely. And what a catch-up that silver has done with gold. If you look at the prices right now, well, we're trading at a 12-year highs in the international markets. And for the Indian markets, after making that all-time high at around 1,05,000 rupees a kg, thereabout is where we are trading at this point in time as well. Well, the gold-silver ratio after hitting 105 did give an indication that silver is a big screaming buy right now. So the gold-silver ratio right now stands at 94, and the silver run-up clearly indicates that. If you look at the prices then, we are gained up by 8.5% for this week alone, and we are up by 24%. So clearly catching up with gold, which is trading 29% higher for this year, while silver is up 24% till time. Well, it is about strong demand from the industrial sector, which is expected to be at record highs in this year after hitting a record in 2024 as well. That has been a supportive factor for silver. Also, this year is going to be a fifth straight year for deficit in case of silver by nearly 21%, and that clearly has been supportive for markets. Well, the industry anticipates that we've done $36 an ounce in the international markets already. Silver is headed to $38, perhaps $40 an ounce as well by the end of this year.
All right, Manisha, thank you so much for that update. Silver, of course, heading higher and higher towards multi-year highs, and that has had an impact on shares like Hindustan Zinc, which is, of course, the only pure play silver company in the country. And the shares were up yesterday as well, and in today's session too, up 1.25%. Take a short break. On the other side, a quick chart check with Somil Mehta from Mirae Asset Sharekhan on the other side, and some trading ideas as well. Stay tuned.
Welcome back. The Nifty is up more than 200 points, 222 points up as we speak. Sensex up close to about 700 points. The Realty Index is racing away. The Nifty Realty Index is up 3%. The BSE Realty Index is up close to about 4.2%. So to talk more about the moves that we're seeing, Ria joins in.
Well, yes, Rima, realty stocks are trading higher post these announcements from the RBI. So let's take a look at what this spells out for the sector. Largely, this is positive for the affordable and mid-income housing segments. Taking a look at what ANAROC has said in terms of the impact of the repo rate cut, they've said that we can see a demand boost in the Indian realty space, especially in the affordable and mid-income housing segments. And this can also lower developers' borrowing costs as well. In terms of the impact of the CRR cut, developers can have more access to capital as a result of the increased liquidity in the banking system, and this can positively impact project completion timelines as well. And they've also said that this gives banks the option to reduce home interest loan rates as well, which can lead to positive sentiment going ahead. Knight Frank has also echoed this sentiment. They're saying that the RBI's 50 basis point rate cut marks a very strong and proactive stance aimed at lifting the low and mid-value housing segments. They've said that they expect rekindling of the lower segments as affordability will witness a meaningful improvement for home buyers going ahead. CLSA had also come out with a note on the real estate space this morning. They've said again that the affordable and mid-income housing segments will see increased demand going ahead. And the key beneficiaries on this front should include developers such as Sobha, Prestige, Godrej and Suntech. In fact, they've also highlighted that REITs and large rental players such as DLF and Phoenix Mills also stand to benefit from lower interest rates on their debt and a slight asset reflation as well. So on the back of this, all of these realty stocks have been trading higher in today's session. The biggest gainers include Hubtown and Ajmera Realty. Even other players like Kolte Patil, DLF, Purvankara, Godrej Properties, all trading with gains of anywhere between 3 to 5% right now.
Strong moves coming in there for a lot of these realty names, and the smaller ones in particular. They are the ones on DLF too is up 7% now, among the top gainers on the Nifty Realty Index. But the one constant factor that has been part of this week has been the slew of block deals that have taken place almost every single day, and today has been no different. Vivek is here with the latest updates on what happened today. Vivek.
Well, gush of liquidity on Mint Street and a gush of liquidity as far as Dalal Street too is concerned. Well, a lot of block deals. So the first one that we are looking at today is Bajaj Finserv, a significantly large one, almost 5,000 crores worth of block of 5,500 to be precise. Two promoter entities, Bajaj Holding as well as Jamnalal Sons, were the sellers in today's block deal. Almost 1.8% of the total equity changed hands. What is it that we need to watch out for? Number one, usage of funds. A calculated, educated guess would be most likely that the promoter entities would use these particular funds to go ahead and settle the dues that they owe to their partner. And along with that, remember there's a 60-day lockup on further sale of shares. So we'll need to see whether after 2 months there is another block deal that happens or whether there is a fundraise via another route. The other stock, again, that saw its block deal happen in the window itself was ZF Commercial. Here it was actually from our colleague Ruchit who had indicated to us the promoter WAPCO, sold a little over 3% stake in the company, almost 780 crore worth of shares exchanged hands. And Azad Engineering, this particular block happened as soon as market opened, almost 7% of the total equity changed hands, a little over 700 crore. And we understand most likely it was the promoter entity that probably trimmed their stake. And lastly, one particular QIP and again a fund raising, IREDA. So, base size of this particular QIP at 1,500 crore, upsize option of 3,000 crore. So total almost 4,500 crore worth of fundraise being done by IREDA. Indicative issue price at 165 rupees a share, almost a 6% discount to yesterday's close. So again, this is an important development to watch out for. IREDA, post this particular QIP, the promoter stake will reduce.
Thank you very much for that. Let's address the market technicals. Somil Mehta from Mirae Asset Sher Khan is now with us. Somil, still not managed to conquer the 25,100 mark, which was the upper end of the trading band. But given the kind of pop that we've seen in the markets now, do you expect that level to be taken out on the way up? Is there a buying opportunity? And even banks, big move on the Nifty Bank, 1.5% up.
Absolutely. I think that this range will be breaking out very soon. We had a range between 24,500 and 24,800. That range has been broken on the upside, which is a good news. Markets have taken support at 20 daily moving average, 10 daily moving average, making hard ups, high bottom on the lower time frame. So all looking great especially the large caps like Reliance, HDFC, Axis Bank, ICICI Bank, all are looking great. Realty sector is looking great. So overall, good sentiments, high top, high bottom formation. This rally is expected to continue. The next target for Nifty would be 25,500 in the short term, medium term, probably 26,000 as well. In Bank Nifty as well, I think this is a clear breakout and the range has broken on the upside. In the very short term, I'll be expecting a target of 56,800 and above 56,800. And I think the next level would be 57,500. So overall, great momentum at this moment, and I will be focusing more on large caps now after a long time, and that's the reason I have two large caps in my buying radar. First one would be Tata Motors. Has been a laggard, has been in a range, but I think this is the right time to go ahead and buy Tata Motors. Stop loss would be 690 and the targets would be 755 in the short term. The second one is Axis Bank. It has just started moving and the targets are around 1280. The stop loss would be 1160.
Interesting. Tata Motors, a buy recommendation from Somil. The one who would not agree with that is JP Morgan, who downgraded the stock today and also cut its price target. But Somil, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Well, it's time to take a short break. More on the markets on the other side. Well, Mount 25,000 is conquered on the Nifty yet again. We closed at that level just last week, but we could not sustain at those levels. Now, courtesy the RBI policy and the twin surprises of a 50 bips and a CRR cut, we are back at that 25,000 mark. We even mentioned this in the morning today that in case there is a 50 bips rate cut, it might just help the Nifty break out from that range that it found itself stuck in over the last couple of weeks. And there you have it, 25,000 now on the index, 250 points higher for the Nifty. And of course, a big contributor to that is the Nifty Bank, which is also continuing to make new highs. Saumil Mehta just mentioned a few minutes earlier that he's seeing targets of 56,800 on the index. So another 200 points higher is where he sees it. So now the Nifty Bank has recovered almost exactly 1,000 points from the lows of the day. So it's a 1,000-point recovery on the Nifty Bank, and that's showing up on the Nifty as well. When you talk about the positives, there's not so good news in terms of the layoffs that are taking place in the US, and they're happening left, right, and center. And it's not just the smaller names; it's the bigger ones that are leading this, Reema.
I think now the big change is that earlier it was more specific to tech. Now it's impacting the real economy jobs, the manufacturing jobs, particularly in consumer and retail, because these two sectors have the added headwind of the tariff impact. So there's all the more reason for them to tighten their belts and save costs. And then you're going to turn to AI to do that. So let me run you through the latest news. You can see that on your screen. So Procter & Gamble has announced its plans to slash 7,000 white-collar jobs. This is about 15% of its non-manufacturing workforce. They're planning to do this over the next 2 years. And the company is saying that the goal is to build a leaner, more agile organization. But they're clearly trying to say that they will be using more digital AI tools because they want fewer people to do more work using better tools. Just some more details. They haven't specified which department, which region is going to get hit as of now. But the company has budgeted $1 to $1.6 billion in pre-tax restructuring costs, which will include your severance payouts, system upgrades, other transition costs. But as I said, another reason why you're seeing this in the consumer retail sector is because of the tariff impact, because the company has said that they're staring at a separate $600 million hit in FY26, fiscal year 2026, because of tariffs and rising raw material. And it's not just P&G. On 21st of May, even Walmart, said that they will be slashing close to about 15,000 jobs. So it's Walmart and P&G's. And this time, as you said, right, earlier, maybe there was a one-off small one. This time, the scale and the numbers are hard to ignore, and it's happening in the real economy jobs.
When the world's largest retailer is planning to cut 15,000 jobs, you can't really ignore it. And of course, it shows signs of worry in the US economy as well. And the macro data that has been presented all through this week has been pretty disappointing, be it the private hiring, be it the initial jobless claims. And of course, today, the all-important non-farm payrolls that come in later this evening, and all eyes of Wall Street will be on that. But moving back to our own markets, then the two automakers that have had divergent moves today, or divergent opinions coming in from brokerages, Tata Motors and Bajaj Auto. We just spoke of Tata Motors a few minutes earlier, as CL and JP Morgan downgrading it, and CLSA has come out with a note on Bajaj Auto. Sudarshan is here to take us through both of those. Sudarshan.
So JP Morgan has downgraded Tata Motors to neutral, and target here is 740. JP Morgan believes that company is facing a multiple of headwinds. First one, tariff risks and aging portfolio in JLR, and second, that industry outlook for FY26 is muted for both commercial vehicle and passenger vehicle. So following that, JP Morgan believes that FY26 is going to be tough for Tata Motors, but things can improve in FY27. Also going forward, two things that will be in focus. Tata Motors is holding analyst meet on June 9, and JLR is going to hold analyst meet on June 16. So investors will be watching out these two meets very closely. Now coming to Bajaj Auto, CLSA maintains outperform call, and target here is 10,149 per share. It has laid out few reasons. First, company is saying that it's gaining market share in 125cc plus segment. Second, upcoming launch of new Chetak is going to help gain market share in electric two-wheelers. Third, company is confident of increasing its growth in export, and led by rising traction in North Latin America and recovery that company is seeing in Nigeria. So on the back of that, it's targeting growth range of 15 to 20% in the export segment. And last, it's eyeing turnaround in KTM by 2026. So factoring all these reasons, CLSA is positive on Bajaj Auto.
Thank you very much for that. Get into a break. But as we do that, we'll get you the latest on how Government of India aims to navigate China's move to curb rare earth magnets.
The rare earth magnets in the last 2 months. Parikshit is now joining in for more details on this. Parikshit.
The government is considering a PLI Government is considering a PLI-like scheme for rare earth magnet manufacturing in the country. Now, this is coming in the midst of a crisis that the auto industry is grappling with. China has put a restriction on export of rare earth magnets around the world, and India is no different. We have to get an end-use certificate, which has to be validated at 7 different levels and finally by the Chinese government. And this is almost like a ban, so to say, and no Indian importer or Indian company has been able to get rare earth magnets from China since the 4th of April. Having said that, the government is now examining industry proposals for financial incentives in setting up assembly and manufacturing for rare earth magnets. Dialogue is on between the industry and the government for an incentive-based scheme. The government is also looking at financial support for both small and large companies in the short and medium term. The industry has proposed setting up of a magnet assembly and processing capabilities in the short term with government financial support, and this includes recycling of old and used rare earth magnets as well. Long-term self-reliance is something that the industry has proposed for rare earth magnets, and this, according to many industry sources, would need a heavy amount of incentives for the government and also public-private partnership so that this relationship and this endeavor to make rare earth magnets have a local ecosystem, a domestic supply chain, is effective and beneficial at the same time. In the short run, it is also being proposed that India should look at sourcing arrangements and agreements with countries such as Vietnam, Brazil, Japan, Russia, Ukraine for that matter, countries which have rare earth minerals, which have processing capabilities. We need to increase our sourcing from them as well. Currently, these discussions are at a very early stage. No draft notification has been prepared. But yes, we're told by top-level sources in the government that it seems it's quite clear that a PLI-like scheme will be needed for rare earth magnets very soon.
Thank you very much for that, Parikshit. Get into a break on the other side. Thank you.
Building on to the gains as we speak, the Nifty is now 270 points higher. 25,020 is where the index stands. The Sensex is now up 850 points, and a lot of these is attributed, of course, to the financial names. And the Nifty Bank too is now 850 points higher at 56,600 after that very, very surprising and a positively surprising RBI policy at that. Take a look at the contributors there: HDFC Bank, Axis, Bajaj Finance, Reliance. So it is private financials and Reliance that is moving on. With that, we call time on this edition of Trading Hour. From Reema, me and the team that put this show together, thank you so much for watching. Ritu takes the action forward in counting down to the RBI Governor's press conference.
Thank you so very much. May I start, sir?
All right. That is the top brass at the Reserve Bank of India set to address the media after announcing that outsized, surprising 50 basis point repo rate cut. Hear out what they have to say.
With us, Governor Shri Sanjay Malhotra, Deputy Governors Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Shri Swaminathan J. and Dr. Poonam Gupta. I would take this opportunity to welcome Dr. Gupta to this press conference after taking charge as the Deputy Governor. We also have with us Executive Directors, Dr. Rajiv Ranjan and Dr. Ajit Joshi, and other friends from Reserve Bank. Before we begin, I'll request all of you to please either switch off your mobile phones or keep it on silent. Please restrict to one question per person so that everybody gets a chance. And then maybe going forward, we can take another question if time permits. And when you are asking question, please see that you switch on the mic which is in front of you. Because that's how, the people listening to this transmission would be able to hear whatever is transpiring here. And once you are done, please switch it off to avoid the interference. Sir, there are 23 participants from media today. And with your permission, I'll call out the names. I'll ask Lata to ask her question.
Thank you, sir. Lata from CNBC TV 18. Governor, thank you very much for the opportunity and for a policy that is giving us a lot of headlines. Okay, I wanted you to clarify things on the liquidity front. In the last few weeks, the repo rate, the call rate was not at the repo rate. You gave enough liquidity and the call rate was 25 basis points below the repo rate. Now that you have given a 50 basis cut, will you use liquidity in such a way to align the call rate more to the repo rate, which means you will do more VRRs, reverse repos, or will the reverse repo have to be suspended because your 40 billion short positions have to be, will mature? So if you can give us a little more color on liquidity, and on the stands itself, is it fair on the part of the market to assume an extended pause? Or, because the positive real rate, I mean, if you assume that that 1.4 to 1.9 positive real rate is what you are also going by, then with inflation at 3.7, you still have space to cut. So should the market assume that the terminal rate can still go down after the pause?
Yeah, so first of all, thank you, all of you, for coming here as usual and taking our message to everyone across the country. So thank you very much. You have asked 3 questions in 1 question. But we'll try to attempt to answer all of them. So first question is a very good question. In fact, what do we do with liquidity? Where do we actually maintain now the call rate? The call rate today is hovering at the lower end of the LAF as it was till yesterday. So it was at about 5.75%. Whether we now maintain it at 5.25 or at the policy rate, which is at 5.5. That's, as I said, we'll see how the situation goes. Of course, liquidity is abundant, and if we do not do any VRR, then it's going to stay at 5.25. If we do VRRs, then, we can bring it anywhere between, depending on the amount. So we'll see, how the situation evolves, and we'll take a call. We have not really given it a thought on that, so we will decide, and you will come to know, in the coming few days. I'll not be able to give you a very precise answer, but having the policy at 5.5, and the stance, now going to neutral, so all that will, certainly come in the picture. We will take a call as to where, we will try to have the call rate. The second question is on where do we see the terminal rate. The MPC, I think, has very clearly, articulated that in the statement, in the resolution that has come in. We have changed the stance from accommodative to neutral. And it has mentioned that there is now very limited space for the monetary policy actually, given the current circumstances. And you are aware of the current circumstances, which is that growth is at about 6.5%. Inflation we are projecting at 3.7% for this year, and next year it's above 4, it's 4.5% or roundabout. So given these current, if these were to play out, there is very limited space is what MPC says, and that's why it has been reduced now. We have changed now to neutral. MPC also states that we will continue to monitor the incoming data, and basis that, given especially the uncertainties, what way now we will move will depend primarily on what the data suggests to us. There was a third question which what was your? That's it. Thank you. So I've
That's what I wanted.
Yeah, thanks.
If you can allow me another question, I will.
Yeah, we'll come back later. Come back and see if there is time.
Thank you, sir. Next we'll have Mr. Mayur Shetty from Times of India.
Governor, you spoke about the uncertain environment, and a lot of uncertainties coming from the behavior of the US administration, and that is also resulting in a lot of volatility in dollar assets. So given this, how would you balance between rebuilding the forex reserves and managing exchange rate volatility?
See, our policy over there is very, very clear. It has been very consistent. And we do not manage, or try to target any price, any level, any band. You are aware of that. If there is any abnormal, that's a standard response, right? Any abnormal volatility, if it is there, that is what we try to counter, and we let the market prices be determined by the markets. Now, this question, and I think that was something that even Lata alluded to, and that was the third point, I think, that you mentioned.
The 40 billion.
Is, this 40 billion, etc. We are not unduly concerned about that. Even if you were to exclude that $625 billion, if you were to exclude this $65 billion, including, the one after 1 year that is coming in, we are not unduly worried, on that. It's a very, very comfortable level to be in. Yes, if there are opportunities and we can build reserves, that will happen. But that is not something which we will be unduly bothered about. Thank you.
Thank you, sir. अब मैं श्री अनुराग शाह से आग्रह करूंगा कि वो अपना प्रश्न पूछें. अनुराग शाह, ET 9 स्वदेश से.
थैंक यू सर. थैंक यू सर. जो सर ने इतने बड़ा धमाका कर दिया, सबको चौंका दिया, जो मेन प्रश्न लेके आया था सर वो भी पूछूंगा साइड में. सर ये आज की जो ऐलान से क्या बड़ा मकसद है और क्या संदेश आप देना चाहते हैं ब्रॉडर रूप में?
नहीं, ब्रॉडर रूप में देखो, संदेश हमारा यही है कि इन्फ्लेशन, आपको मालूम है, मुद्रास्फीति इन्फ्लेशन पे अब काफ़ी जो है नियंत्रण में है, और वो जंग जो है हम ये मान सकते हैं कि उसके ऊपर में हमने जीत हासिल कर ली है. तो एक मैसेज है, क्योंकि हमने 4% से उसको घटा करके जो हमारा अनुमान था उसको 3.7% किया है मुद्रास्फीति को. उसी प्रकार से जो ग्रोथ है वो 6.5% है, अच्छी है, लेकिन उसमें और गुंजाइश है, उसके अंदर में और बढ़ोतरी होने का. तो जो भी हमें कार्य करना है, हम ये बिलीव करते हैं कि वो डिसाइसिवली करना चाहिए, सही समय पे करना चाहिए, और एक जो निश्चितता है, इस अनिश्चित वातावरण में निश्चितता मेरे ख्याल से जो है हमें मार्केट्स को, सभी को, बैंक्स को, इकोनॉमी को निश्चितता देने का बहुत अधिक ज़रूरत थी. इसी वजह से ये जो आपने देखा कि एमपीसी ने कहा कि हमने फ्रंट लोड किया है, ताकि एक ये निश्चितता रहे कि हाँ 50% हमें बेसिस पॉइंट्स कम करना है, तो एक साथ ही उसको कर दिया. उसी प्रकार से जो सीआरआर का है, हम चाहते तो हम इसको 4 महीने बाद भी अनाउंस कर सकते थे, हमने आज ही अनाउंस कर दिया.
पहले से ही, ताकि लोगों को, बैंक्स को ये निश्चित हो जाए कि लिक्विडिटी, जो कि हमने कहा जरूर है लेकिन वो एक्शंस में भी तब्दील होना चाहिए, तो वो एक्शंस में हमने अपने तब्दील किया कि जो CRR है वो एक हमने उसको आज ही घोषणा कर दी। तो निश्चितता जो है जितनी होगी उतना हमें लगता है कि उससे हमारी जो अर्थव्यवस्था है उसको बल मिलेगा, और यही हमारा संदेश है कि हमारी अर्थव्यवस्था अच्छी चल रही है, और उस अर्थव्यवस्था को दोनों मुद्रास्फीति को ध्यान में रखते हुए, वो हमारा प्रमुख संदेश है, उससे हम बिल्कुल नहीं भटकेंगे। वो हमारा प्रमुख प्राइमरी हमारा जो मोटिव है कि प्राइस स्टेबिलिटी, मुद्रास्फीति को हम कंट्रोल करें, उसके ऊपर में हम अंकुश लगाएं, और जो हमारे को टारगेट दिया है उस टारगेट की ओर हम उसको ले जाएं। जब वो हो जाए तो उसके बाद में हम जो ग्रोथ है, ग्रोथ के ऊपर भी हम ध्यान दें, वही हमने इसमें किया।
जो स्टांस आपने चेंज किया था, पिछली पॉलिसी में ही आप न्यूट्रल से अकोमोडेटिव आए थे और इस बार वापस एक ही पॉलिसी में आप वापस उस स्टांस पे चले गए, तो उससे कहीं एक मैसेज गलत नहीं जाएगा?
गलत मैसेज से मैं नहीं समझा। हाँ, ये बात आप जरूर कह सकते हैं, ये बात हमारे भी दिमाग में थी कि हमने पिछले बार ही तो इसको अकोमोडेटिव किया था। हमारे पास में चॉइस ये था कि हम उसको अकोमोडेटिव रखते, जो हमने बोला था, जो मैंने आपको कहा कि बोलते रहे कि अकोमोडेटिव है लेकिन करें नहीं कुछ, तो एक्शन जो है वो ज्यादा इंपॉर्टेंट है, और जो भी हम बात कर रहे हैं वो एक्शन में तब्दील होना चाहिए। इसीलिए जो है हमने उन हमारे जो स्टेटमेंट्स रहे इंटेंट के, अकोमोडेटिव केवल एक इंटेंट था, उसको हम अकोमोडेटिव रखते रखते नहीं चेंज करते, अकोमोडेटिव ही रखते, तो क्या वो बेहतर रहता, या हम सर्टेनिटी दें कि हाँ हमने अकोमोडेटिव से जो हमने आपको वादा किया था कि हम इसको रेट को कम करेंगे, डिसाइसिवली कम करेंगे, वो हमने किया, और स्टांस को हमने न्यूट्रल कर दिया है। आज के सर्कमस्टांसेस में जो स्थिति बनती है उसके हिसाब से बहुत कम गुंजाइश, जैसा कि MPC ने नोट किया कि उससे बहुत कम गुंजाइश अब रह जाती है, वेरी लिमिटेड स्पेस, उन्होंने कहा वेरी लिमिटेड स्पेस, तो कम गुंजाइश रह जाती है आगे और पॉलिसी रेट्स को कम करने की। ये एक पूरा संदेश हम दें, इसीलिए उसको न्यूट्रल में किया गया है।
धन्यवाद सर। मूविंग टू दिस साइड ऑफ द टेबल, मिस्टर मनोजीत शाह फ्रॉम बिजनेस स्टैंडर्ड।
Good afternoon. Thank you, Punitji. Again on this stance, I mean,
Thank you.
This policy has several surprises. The most surprising part is the stance. As you said in the last policy, the accommodative means the rate can go down or it can stay there. So in that, so neutral would mean the rates can go up. Are you saying rate will not go up, but there will be a long pause? And whether there is a voting on stance, if you can...
It will depend. See, it will depend on data now. This is what neutral means. We had explained it in our earlier MPC. I had explained it in the earlier MPC statement that neutral will mean that it can go either ways. It will depend on how the data comes in. If the growth is weaker, it can mean that it will go down. If the growth is good, inflation is going up, it can mean that, you know, the repo rate can, policy rate can go up. So it will depend on how the data, both, you know, on inflation as well as growth turns out to be.
Was there voting on stance this time?
Stance, we have already mentioned that there is no, I mean, the statute does not, mandate a voting. There was a discussion on it, certainly, because we need to give a sense, we need to give a guidance. It's more of a guidance that we have to give to the market participants. And so there was a discussion, and everyone, all the 6 MPC members were of the view that we should change it to neutral. So there was no voting, but the view of all the MPC members is that going forward, the stance should be changed from accommodative to neutral.
Also, if you can add just one more, are you satisfied with the monetary transmission that has happened so far?
I think it has, going by past trends, the transmission has happened much faster, both on, in the money markets, in fact, you can see a huge transmission, more than what we have done, more than 50 basis points in the money markets at the shorter, especially at the shorter term levels. And on the credit side also, we are now seeing some initial signs. Deposit rates, in fact, have been reduced, retail as well as wholesale, by most of the banks. About 40 basis points, they have reduced. The average, of course, is about 27 basis points. It has reduced over there. 17 basis points is the reduction on the credit side, on the outstanding credit. And in terms of fresh loans, there is that's a little slow, but it has started. It is about 6 basis points as per data that we have. So that's slow, but it is much faster than other times. Normally, it takes 6 to 9 months. It's only been 4 months from the first policy cut. So from first policy cut, or 25 basis points, against that, if 27 basis points on deposit side, 17 basis points on the credit outstanding side, and 6 basis points on the fresh loans, I think this is a very good transmission. However, we need to do it faster. And that's why we have front-loaded some of our actions.
Thank you so much.
Thank you, sir. Next, we'll have Mr. Vishwanath Nair from NDTV Profit.
Good afternoon, Governor. Couple of questions, actually. The first one with respect to your GDP forecast, which has not changed. The estimates have not changed at all. What is the growth boost that you're expecting from this cumulative 100 basis point rate cut that you've afforded? And thereby, would there be a revision for FY26? And the second part is on the stance itself. I'm asking you again, in the past there has been criticism that the stance is more or less becoming meaningless because we kept saying withdrawal of accommodation, but it was a prolonged pause. Is this a way to then bringing it back into relevance?
So your first question is what impact it has on growth. Obviously, it has a positive impact. It will be very difficult to assess as to how this transmission from monetary policy to the credit rates and then to the real economy, how that transmission happens. As you are aware, it takes minimum of, going by history, 6 to 9 months. We would like, of course, to expedite it, but we'll see impact of this only in the later half. So for this year, in terms of numbers, especially when there is so much of an uncertainty, we would not be in any position to give you how it will, to what extent it will impact the GDP numbers. The second question is on, I can't actually speak about the past, what has happened, but our policy will be very, very clear. Whatever we are saying, we mean it, every wee bit of it, and you will continue to experience that.
Thank you, sir. Next is Ms. Swati Bhatt from
also
the Repo.
To be kept in mind is, whether it is past or present or future, a lot of it is dependent on data. So if the data kind of changes, even if it is, say, accommodative or tightening, it does not necessarily mean, that next policy itself, you are going to tighten it or you are going to reduce the policy rate. It does not mean that. It depends on how the data is actually coming in, and how, what that data is showing. So if that data demands that you have to actually stay put, even if it is accommodative, it will, that's how, it will be done.
Thank you, sir. Next will be Swati Bhatt from Reuters.
Thank you, Puneet, sir. Sir, I just wanted to understand, you have front-loaded the rate cuts and the certainty obviously helps. But we've seen that despite the massive surplus liquidity that has been there in the market, there is very limited scope to lend because there is genuine lack of demand from companies and corporates. There's not much capex happening as well. How does this liquidity really translate to boosting growth? What is the advantage of having so much, flush of liquidity in the banking system? Similarly, on the CRR front as well, obviously you planned it in advance and announced it now. But CRR historically has been at the 4% sacrosanct level to some extent. Is there a renewed thinking on the CRR front, which is why you've gone ahead and cut it to 3%? Thank you.
Can I just add, nowhere you've told us why you cut the CRR. What was the RBI's thinking?
So let me take the second question first. I think the monetary policy statement that I read out, it did mention that it has two objectives. The first objective is that we need to, continue to provide liquidity, and I'll come to your first question relating to liquidity. And then we also mentioned that it will not only improve liquidity, but it will also help reduce cost of funding for the banks. So that is the other objective. And see, over the years, last 12, 13 years data I've seen, and one can even go back, the CRR has mostly remained at 4%, as you have rightly pointed out. During COVID, we reduced it by 1%. Now these reserves are basically kept for liquidity management. So the experience as of now does not suggest that perhaps, we do not need 4%. 3% can perhaps suffice. Having said that, we do not know what the future holds. So please don't hold me, to this number that, we are going to maintain this 3%. But as of now, it seems that 3% is a comfortable reserve ratio to have. And so from a liquidity management perspective, and so that's why, apart from providing liquidity, it will also reduce their costs and improve their NIMs by about 7 basis points, at least it should help, is our estimate. Why do we provide liquidity? So that, there is a better transmission, there is a faster transmission, and it is primarily, it's basically for that. Thank you.
Thank you, sir.
Take the next question.
Yeah, because so far banks are not lending. So how does that demand come in?
It will depend. We have said, even in the statement, that this is not a sufficient condition. Monetary policy is not a sufficient condition. It is a necessary condition. We have provided that. We are confident that it will certainly translate into better credit growth. I am not able to give you a number. Obviously and certainly, with confidence, one can say that it will certainly increase, the flow of credit. And so that's why, this liquidity is important. A reduction in repo rate is important. To what extent and what time frame it will take, that will be difficult to say.
Thank you, sir. Next will be Mr. Ankur Mishra from ET Now.
Thank you, Puneet sir. Good afternoon, Governor. I want to understand from you that you have given a statement in the monetary policy that today's steps should be seen towards propelling to a higher aspirational trajectory. You're talking about growth. You have kept your target intact at 6.5%. Is there a scope of further revision ahead which should be expected with the kind of actions you have taken? And also, I will once again ask on the stance front, but in a cricket analogy, if you can explain, it was a roller coaster kind of a policy. We saw you announced 20, expectation was 25 basis point, you announced 50 basis point cut. Similarly for CRR, the expectation was 50, you announced 100. But on the stance front, you got back to the crease and said, I'll wait and watch. So how should one understand?
Well put. The target, you are saying that the target, the 6.5% is not the target, 6.5% is the forecast that we have made. And the aspiration is certainly much more, between 7 and 8%, is our aspiration. Aspiration is 8%. We would like to grow, as fast as possible. You have said it all, I don't have to say anything more, on, you have put it out very well. As to what, this monetary policy, because everyone here in India, they may not understand our monetary policy, but they will understand the cricket lingo. So you put it out very well for your viewers.
Thank you, sir. अब मैं जी बिजनेस से एकता सूरी को आमंत्रित करूंगा।
Policy has been very well received by the markets. However, I want to ask questions which are a little different from the market how they've received it. So मेरा पहला सवाल होगा, पिछली पॉलिसी में हमने गोल्ड लोन्स के ड्राफ्ट के ऊपर बात की थी। उस पॉलिसी से लेकर अब आज की पॉलिसी में आपने कुछ चेंजेस सोचे हैं? क्योंकि बहुत से लोगों को ऐसा भी लगता है कि अगर सोना हम गिरवी रखने जा रहे हैं तो हो सकता है हमारे पास ओनरशिप का कुछ प्रूफ ना हो, क्योंकि वो हमें अपनी मदर या किसी और से मिला हो, या फिर हॉलमार्क ना हो। तो ऐसे जो ट्वीक्स हैं आप सोच रहे हैं नियमों में बदलाव? और दूसरा ये भी, क्योंकि अब हम देख रहे हैं कि फॉरेन बैंक्स की बहुत दिलचस्पी है भारतीय बैंक्स में, तो आप FIIs को लेकर भी कुछ नियमों में बदलाव सोच रहे हैं? 26% का जो वोटिंग राइट है वो भले ही सरकार के पास है, या फिर फॉरेन बैंक कितना स्टेक ले सकते हैं भारतीय बैंक में?
अच्छा, आपने सवाल किया है जो गोल्ड लोन के बारे में, ये भी काफी चर्चा में रहा है। मुझे लगता है कि ये सभी के लिए एक रुचि का विषय होगा, तो इस पे निश्चित रूप से आपका सवाल जो है बनता है। और मैं आपको बताना चाहूंगा सबसे पहले कि जो गोल्ड लोन के बारे में जो हमने रेगुलेशंस जारी किए थे वो केवल ड्राफ्ट थे, मसौदा थे, वो फाइनल नहीं थे। आपको ये भी बताना चाहूंगा कि हमने अब एक फ्रेमवर्क रेगुलेशन मेकिंग के लिए हमने एक जारी किया है, जो सबको हमने पब्लिक नोटिस के थ्रू हमने सबको बताया है कि कोई भी मेजर, जब भी हम कोई परिपत्र या रेगुलेशन या डायरेक्शन इशू करेंगे तो उससे पहले हम दो चीजें करेंगे। एक चीज हम कंसल्टेशन करेंगे, दूसरा हम उसका क्या इम्पैक्ट है उसका हम स्टडी करेंगे। तो उसी को ध्यान में रखते हुए ये भी हमने मसौदा गोल्ड लोन के बारे में हमने जारी किया। दूसरी चीज बताना चाहूंगा कि ये जो हमने जारी किया है इसमें कोई नयापन नहीं था, इसमें कोई नई चीज नहीं थी, ये केवल कोई नई बात नहीं थी। पुराने जो हमारे परिपत्र थे, पुराने जो रेगुलेशंस थे, उन्हीं को हमने कंसोलिडेट किया था, उनको कंसोलिडेट किया था और उनको रिआइटरेट किया था, क्योंकि ऐसा देखा जा रहा था कि कुछ जो हमारे रेगुलेटेड एंटिटीज हैं उनको वो अक्षरतः पालना नहीं कर रहे थे, क्योंकि उसमें क्लैरिटी नहीं थी और इसके बारे में उनको बताया गया था। इस कारण से इसमें कोई नयापन हालांकि नहीं था, लेकिन फिर भी जब वो बात बिल्कुल ब्लैक एंड व्हाइट में सामने आ गई तो इसलिए उसके ऊपर में हमारे पास में उसके कमेंट्स आए। तो मेरे ख्याल से आज ही हम जो है उसका फाइनल जो रेगुलेशन है, फाइनल डायरेक्शन है, आज नहीं तो एट द मोस्ट मंडे, सोमवार तक हम उसको जारी कर देंगे। आपने जो बात कही ओनरशिप के डॉक्यूमेंट्स के बारे में, वो जो हमने ड्राफ्ट जो इशू किया था उसमें भी ये बिल्कुल क्लियर लिखा हुआ है कि अगर आपके पास में उसके इनवॉइस नहीं है तो आप उसका एक सेल्फ डिक्लेरेशन आप दे सकते हैं, तो उसमें कोई चिंता की बात नहीं थी उसको, और हम उसमें और क्लैरिटी हम प्रोवाइड करेंगे। दूसरा ये एक बात आई कि क्रेडिट अप्रेजल, अब छोटे छोटे लोन के लिए क्रेडिट अप्रेजल नहीं किया जाए, तो वो भी हम इसमें डाल रहे हैं कि छोटे जो लोन्स हैं 2.5 लाख रुपए तक के जो लोन्स हैं उसमें गोल्ड से जो जिसमें कोलेट्रल आ जाता है उसमें क्रेडिट अप्रेजल की आवश्यकता नहीं है। तीसरा एक एंड यूज के ऊपर में बात आई थी कि एंड यूज की मॉनिटरिंग करनी है, उसमें भी हमने ये स्पष्ट किया है कि एंड यूज की मॉनिटरिंग तभी आवश्यक होगी जब आप उसका प्रायोरिटी सेक्टर लेंडिंग में उसका लाभ आप लेना चाहते हैं। चौथा और पांचवा जो कि महत्वपूर्ण प्रश्न एलटीवी के संदर्भ में है, वो हमने कहा है कि एलटीवी केवल जो कंजम्पशन लोन्स हैं उसमें ही, कंजम्पशन लोन्स में ही एलटीवी का सिद्धांत लागू रहेगा। बाकी में आप क्रेडिट अप्रेजल करेंगे, उसकी और अन्य इनकम्स हैं और सिक्योरिटीज हैं, उसके हिसाब से अगर एलटीवी रेशियो से ज्यादा भी देते हैं तो वो रीपेमेंट कैपेसिटी के बेसिस के ऊपर में उसका आकलन करके वो दिया जा सकता है। और पांचवा और महत्वपूर्ण जो प्रश्न है एलटीवी से ही संबंधित है, वो 75% हमने उसमें अभी आज के दिन में हमने ड्राफ्ट डाला था, उस 75% को हम छोटे लोन्स के लिए 85% तक करने का हमारा प्रस्ताव है। 85% छोटे लोन्स के लिए, बिलो 2.5 लाख के लोन्स के लिए पर बोरोवर 85%, लेकिन इस 85% में इंटरेस्ट जो है वो भी इंक्लूड करना होगा। तो पहले वो केवल हमारा 75% था और प्रिंसिपल एंड इंटरेस्ट का ही था, जो कि कुछ कंपनियां, पब्लिक सेक्टर बैंक्स जो हैं, अधिकतर सभी पब्लिक सेक्टर बैंक्स 75% पे ही दे रहे थे, इंक्लूडिंग इंटरेस्ट प्रिंसिपल। इसलिए वो प्रिंसिपल जो है केवल 65, 66, 67% तक ही दे रहे थे। लेकिन कुछ अन्य NBFC इत्यादि और कुछ छोटे बैंक भी हो सकता है, वो जो है 75% प्रिंसिपल दे रहे थे, तो इंटरेस्ट मिला करके बुलेट रिपेमेंट लोन में विशेषकर वो 88% तक भी चला जाता है। क्योंकि अगर 18% का लोन है तो आप रिवर्स कैलकुलेट करोगे तो वो 88% तक चला जाता है। तो छोटे लोन 2.5 लाख रुपए तक के लोन के लिए इंक्लूडिंग इंटरेस्ट 2.5 लाख प्रिंसिपल प्लस इंटरेस्ट। तो ये पूरी स्पष्टता जो है हम अपने सर्कुलर में देंगे। हमें उम्मीद है कि इससे जहां पे मिनिमम रिस्क के साथ में इस गोल्ड लोन की श्रेणी को हम अच्छे से रेगुलेट कर सकते हैं। दूसरा आपका प्रश्न है कि क्या हम FIIs वगैरह के लिए हम कुछ लिमिट्स वगैरह, फॉरेन बैंक्स वगैरह के लिए लिमिट्स वगैरह कुछ बढ़ा रहे हैं। तो देखिए ऑलरेडी लिमिट्स तो 74% की लिमिट है, ऑलरेडी 49% की लिमिट है ऑन ऑटोमेटिक अप्रूवल रूट एंड अनदर 25% तो अप टू 74% गवर्नमेंट अप्रूवल रूट में जा सकते हैं। तो उसमें तो कोई बदलाव की आज के दिन में कोई ऐसी कोई बात नहीं है, उसमें कोई चेंजेस मुझे नहीं मालूम ये प्रश्न कहाँ से आ रहा है कि उसको हम चेंज कर रहे हैं। एक दूसरा उससे जुड़ा हुआ है 15% हम अलाउ करते हैं नॉन रेजिडेंट्स के लिए, लेकिन केस टू केस बेसिस पे 15% से ऊपर भी वो जा सकता है। तो उसमें कोई ऐसा बदलाव अभी अति शीघ्र कोई भी बदलाव उसमें नहीं हो रहा है। हाँ, हमने ये इस बात जरूर कही है कि हो सकता है उसका आप लोगों ने उसको आपने देखा हो, कहीं पे पढ़ा हो, कि हम ये पूरा जो ओनरशिप स्ट्रक्चर है, जो एलिजिबिलिटी कंडीशंस हैं, जिसके अंदर में FFI नॉन रेजिडेंट्स के लिए आज के दिन में 15% है, उस सबको हमको पूरे को एग्जामिन हम कर रहे हैं। वो इमीडिएटली नहीं होगा, उसमें समय लगेगा। ये जो है बहुत डीपर क्वेश्चंस हैं जिनको क्रिकेट की एनालॉजी में जो है 2020 मैच की तरह से नहीं देखना चाहिए। तो वो हम उसको पूरा सोच समझ करके ही क्या हमारे अर्थव्यवस्था के लिए क्या उचित है उसको ध्यान में रखते हुए, क्योंकि बैंक्स में देखिए एक आम साधारण आदमी ट्रस्ट करता है बैंक के ऊपर में, जैसा मैंने एक जगह पे इंटरव्यू में कहा, ही ट्रस्ट्स हिज मनी विद द बैंक्स। तो उस प्रकार का ट्रस्ट वर्दी आदमी, ओनर और मैनेजर बैंक में होना जरूरी है। उसके लिए हम किस प्रकार की एलिजिबिलिटी क्राइटेरिया रखें, किस प्रकार की कंडीशंस रखें, उसके लिए सबसे बात करके और उसको निश्चित रूप से हमारी इकोनॉमी ग्रो कर रही है, अर्थव्यवस्था हमारी बढ़ रही है, तो उसमें हमें और अधिक बैंक्स की आवश्यकता है और उसको ध्यान में रखते हुए जो भी उसमें यदि कोई बदलाव की आवश्यकता होगी तो उसमें बदलाव किए जाएंगे।
धन्यवाद सर। Now I'll request Ms. Sangeeta Mehta from Economic Times to ask her question.
Most of my monetary policy questions are taken away. So I'm going back to the annual report, which was very insightful. It had a lot of data points also. There's one question on the one thing about the annual report where you have said that in FY 25-26, RBI would be considering differentiated regulatory framework for type 1 NBFCs, which are without public funds and non-customer facing NBFCs.
See, it is our policy to have, to as far as possible customize the rules basis the risk profile. And so it is only, in continuation
of that particular policy that we have, that mention has been made in the annual report. I'll request DG in case he would like to add something more on this.
No, I think review is done as a regular process, and type 1 is one which doesn't face outside to the system. So we are having a look at the regulation. So that is an ongoing process. We are doing that. That's it.
There would be kind of new guidelines coming for this kind of NBFCs on fundraising. I mean.
No, type 1 typically doesn't have outside liability.
Yeah. So is there any
it will
new?
Be depending purely on the internal resource accruals from that.
Yeah, no, are there new guidelines coming for this type 1 type of NBFCs? That is
We'll
what I
review and then see what kind of regulations.
It only means a review will be carried out.
Okay.
If at all there is a need, then we will do it.
Okay.
So that's the third part of our regulation making framework that we announced. Let me, I mentioned about two important elements for those, because I answered that in Hindi. I think it is important for everyone to know and understand that we have issued a regulation making framework now. There are three critical elements in it. One, that we will do a public consultation. And when I mean a public consultation, it is not only in letter, let me assure everyone, it's not only in letter, it is also in intent. So, so that, the important stakeholders, their views, we get all important stakeholders. The second thing is that we will also do an impact to the extent possible. It may be qualitative. Every time, it may not be possible to do a quantitative impact analysis. What will be the impact thereof on the banking system, on the regulated entities, on the customers, on, all the stakeholders. That is the second element. And the third element is that we will regularly review our regulations, directions, etc. because it is dynamic. Policies have to, change with the times. And so it is only, in that context that we are going to review some of these policies related to type 1 NBFCs.
Thank you, sir. Now it will be Mr. Anup from Bloomberg.
Thanks, sir. Sir, Anup here from Bloomberg. Interesting choice of words. Monetary policy is left with very little space to support growth. Does it mean that you would expect fiscal authorities to support rest of the growth and your growth aspirations that India should have? And also, even after all these measures that banks ever...
I believe in doing my work, right?
Right, sir.
And we have done, that bit. And obviously it is expected that, everyone else will be doing, their bit. So that is not something for me to say, right? It's not appropriate. I believe in doing my job, and that's what, we will continue to do.
Right, sir. Sir, one more question. If, despite everything that you have done for banks, they have ever asked for, banks really do not do the transmission, can you take actions? Or what kind of actions can you take?
See, it is... Ultimately, we have said this in our policy statement also, that monetary policy is a necessary but not a sufficient condition, right? So for monetary policy transmission to happen, there are so many other things, including demand, which has to be there, and so. It will depend on the macroeconomic conditions and the demand and the appetite and the demand for credit. Only then, it is the market forces ultimately. See, we have to leave it to market forces. We cannot start regulating that, no, you give credit or you reduce rates. No, you can't do that. It's the market. We believe that our markets are deep, credit markets. There are so many banks, there are so many NBFCs, there are alternative investment funds, now vying, for credit. There is private credit. And so the market forces will certainly, be able to push prices basis demand for credit.
Thank you, sir. Hamsani from Money Control.
Thank you. Hi, I'm Hamsani from Money Control. My question is
with regard to the health of the banking system as such. You mentioned in your speech earlier today that you're convinced, you remain quite confident about the health of the banking system. But there's one of the private sector banks where the auditors have recently qualified certain developments as likely to be fraud. Has that been escalated to RBI? What sort of actions you are planning to take on that? And it's been about 4 months since we saw RBI issue a statement in favor of the bank saying that deposits are healthy. What is your assessment of the picture right now, sir?
Well, normally, see, we do not comment on individual banks. As I said, system as a whole, banking system is very, very robust. And I also mentioned, that these events or episodes, I would call them, these will happen. They should not bother us too much, as long as, they are far and few between and limited. I think the bank has taken enough number of steps to put their, to improve their accounting and other practices. And on the whole, I think the bank is, doing well. I will request DG, Mr. Swaminathan, if he would like to give more details to the extent.
Sir, thank you. I think you've summed up in terms of what is the current situation as far as this particular entity is concerned. You would recall that in the last MPC presser as well, we had said 2-3 things that all of them have been sort of complied with at this point in time. Number one was our priority to have that accounting done properly, accounting for all the discrepancies duly supported by both internal and external audit, and it must be accounted for in Q4 itself. So that has been accomplished by the bank already. Second, we said that forensic audit and accountability must be held so that people are held accountable, and the examination of fraud has to be completed, and law enforcement should take over from there. So that has been accomplished already. And third, of course, our priority is always to ensure that no customer is put to any loss or any inconvenience. That is something which has been ensured, and there is no systemic impact arising out of these kind of episodes. And fourth, we had also said that each of these crises gives us some lessons, so we sharpen our supervisory tools and we calibrate our supervisory approach basis the lessons that we learned from this. So we are going forward, we will look for these kind of red flags so that we are in a position to anticipate them much in advance. So at last, in terms of succession planning, anyway, all of you know that the board and management has been sharing with you the updates. So as Governor said, whatever that was supposed to play out over the last 3 months has been is more or less on track, and I'm sure that it should be, if not immediately, but at least very soon, it should settle down and then be back to normal. And we will keep monitoring this. Not only this, but the system as a whole.
Thank you, sir. If I can be allowed to ask one question. On the deposits front, a large part of transmission would be dependent on what banks decide on.
You are taking away someone else's time. Huh? So hold on. If your question is not taken up by someone else, then we can come back.
Thank you.
Okay. Thank you, sirs. Next we'll have Gopika from Mint.
Thank you, sir. Good afternoon, Governor. You have lowered your FY26 inflation forecast to 3.7%. What would be your FY27 inflation forecast? Did you mention
6.5%? Sorry, 4.5%.
Right. So you're expecting it to go beyond 4%.
Yes.
And also on CRR, you're expecting it to be staggered from September till November.
Yes.
What if the global situation, I know you are giving a clear indication to the banks, but what if globally the environment changes, inflation shoots up? I mean, if there's some risk, how would you sort of then ensure that the CRR is...
We have enough tools. See, CRR is not the only tool for monetary policy or liquidity. You have the OMOs, you have the swaps, and you have, the VRRs and the VRRs. So if liquidity has to be managed, which we actually do not, today feel that there would be a need to reverse any of those things, we have sufficient tools to do it.
Hamsini's question on the private sector lender, how will RBI ensure accountability from the board? So far we've not seen any action at that level, but don't you think the board is also responsible for what has happened?
See, individual, so you are talking about the IndusInd Bank, etc. I think, see, the MD CEO, has resigned, and it says, for taking, moral responsibilities. So I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
So, sorry for interruption. Just even SEBI has now issued an interim order saying that there is some kind of insider trading which might have happened, and where the notices have been issued. Bank is claiming that fraud has happened to them. So I want to understand, sir, have they reached out to you particularly, because they mentioned in the call that they will reach out to regulator or the investigative agencies due to the fraud scenario. So, I mean, this is something which is related to one bank, but it is the system of trust.
There are other criminal acts that have happened, and the law will take its course. Please be assured. And in case RBI has to step in and take any action, then RBI will not be failing in its duty. Let's leave it at that. Let's leave it at that.
Thank you, sir. Thank you, sir. Thank you. No, please, sorry, because there are others.
Let's not be, there are other people. You've already, asked your question.
Thank you, sir.
And let's not, preempt. Let's not preempt, and let's not be speculative about it.
Right. Thank you so very much, sir. Next, we'll have Mr. Piyush from Hindu Business Line.
Good afternoon, Governor, DGs. Thanks, Puniji. Sir, on unsecured loans, you said personal loans, the stress has come down a little bit, but MFI stress continue to, be present. So, are you looking at taking any other measures to address this? Sir, there have been, couple of a payment bank had applied for a SFB license around more than 18 months ago. Then 2 SFBs have now applied for universal license. Is there any timeline, sir, as to, in all the other things RBI has a timeline of approval. So is there any timeline where you will, give the approval? And sir, just one clarity, this time you did not issue any statement on developmental and regulatory
3 questions you are asking.
This is a clarification, sir. We didn't see this time.
Clarification, what do I clarify if it is not there? But I'll only say this, that we believe in actions. We don't believe only in making statements. There are already, enough work that, we have on our hands. And so, we will first, we will try to, because a lot of drafts, you are aware, a lot of drafts are like gold loans you mentioned, and there are others. Thank God you are not asking me about those. You are not asking me about those, what about those drafts? You are asking me, to give more and more and more. So, we will rather, be trying to therefore consolidate, whatever we have already put in the pipeline, what we have already, we have promised. And so, we don't have to necessarily, speak if there is nothing to be spoken, right? What are your other questions? Banks. Banks licenses, see, I don't think there is a timeline, but it does not mean that, we don't have an internal timeline. Let me assure you that work is in progress in all those applications that you have mentioned, and very soon you will find our decisions. We have already articulated a decision on one of them, which we have rejected. One of them is already rejected. If you are not aware, then let me mention it's already there, and the others also we will quickly.
Sorry, sir. What was which application was rejected?
It's not.
It will be coming out.
It will be coming out as a press release. As a press release, it will be coming out. You will know.
Today it will come out?
Can't promise, but we will try.
Sir, on
shortly.
MFI, sir, will you take any more measures? Thank you.
There are no specific regulatory measures planned for MFIs. There are none. There is something else, related to MFIs, but that is not, for this particular purpose. On the supervisory side, if you would like to add anything, on the MFI, because they have been actually recalibrating their business. We have been engaging with them, through supervision. And so, if you would like to add, on the MFI portfolio, that will, I think.
Yeah, thank you, sir. But I think that has been already articulated in the MPC statement in itself, that the entities that are predominantly in this particular segment have already identified, recalibrated their business models, stepping up upon their collection methodologies. And you've also seen a shrinkage of that portfolio on account of that because of their recalibration. So maybe over a period of time, maybe over the next couple of quarters, this should stabilize. Like the other two segments also, we saw outlier growth, we took some steps and then it moderated. So this also should going forward, but it also depend on the overall economic conditions, income level, because MFI book is to the most vulnerable segment. So that's something which we'll have to bear in mind, give it a little more time for normalizing. But we'll keep watching those numbers. But as Governor said, on none of these segments, there are any regulatory actions or measures that is warranted at this point in time.
Thank you, sir. Sir, with your permission, last three questions.
Yes.
Thank you, sir. Next, I'll have Mr. Ashish Agashe from PTI.
Thank you so much, sir. Sir, this is a follow-up to Piyush's question on the unsecured lending bit. So, given that, there's an explicit intent to push credit growth, so should we expect some bit of going back on the risk weights order as well of November 23? And so secondly...
Whatever had to be done has been done on that account. Whatever was there, see, prior to COVID, whatever were the risk weights, some relaxations were given during COVID, which were withdrawn, and that's all. If there is any tightening which has happened, that has also been withdrawn. So there is no more, thing on the risk weights.
And so following the Supreme Court pronouncement on the crypto matter, has there been some conversation regarding, like the RBI stance has been clear from the past itself, but given that...
There is no new development insofar as crypto is concerned. There is a committee in the government, which is looking after this. Of course, you are aware we are concerned about crypto in case, because that can hamper, financial stability and monetary policy, etc.
Thanks.
Thank you, sir. Doordarshan se Shama, you may please ask your question.
Namaskar, sir. So your docu-series are out and they are good. I want to know that generally RBI is known as conservative. So this idea of telling your own story, how did it come from?
I think I'll have to ask, those people, who were involved in, so maybe DG Ravi Shankar, you can tell
public. And in that context, we thought of, this docu-series. The idea of this docu-series is to show what RBI does in a language and visually that an average person understands. Thank you.
So only one episode is out yet. So how many total episodes are there? And
there are 5 episodes. They'll come one after the other.
Okay.
Thank you, sirs. Lastly, we'll have Mr. Hitesh from Indian Express.
Good afternoon, sir. Sir, in your annual report, you mentioned that one of the agenda for you would be studying monetary policy transmission. As part of it, you will be revisiting optimal level of system liquidity. So what is that liquidity level which you are looking so that transmission is effective?
So the study will look into those aspects. That's why it's there. I mean, if I knew the answer, then it would not be there in the report. The study will, go into those details as to how the liquidity should be maintained, so as to be able to transfer or translate monetary policy into the money markets and then to the credit markets.
Thank you, sir.
Mr. Governor, my question's not been asked. Therefore, if I can be allowed to ask my
How many are
question.
left?
I haven't had an opportunity.
Only
Just
two?
one question.
Okay.
So there are three actually.
Okay, we take last three.
Okay, continue. Okay.
Thank you. With respect to transmission, much of transmission will depend on how banks look at their deposit rates. And where we are today, we've not seen much of a correction on the deposits front. Banks continue to keep deposit rates higher, and because the fight for deposits is still clearly there in the system. So how do you expect this particular aspect to pan out, sir? And what sort of transmission do you expect to happen on the deposit side? How soon you expect that to happen for the lending rates also to recalibrate?
I think this question was already asked and I already answered it also. But I'll still repeat it. See, 27 against 25 basis points cut that we did in February, there is a lag, you are aware. It will not happen overnight. On the asset side, about 45% of our loan book is linked to external benchmarks, which gets immediately transferred. But on the deposit side, there is no such mechanism. Despite that, and so there is a lag. So we need to understand, as I already mentioned, that there is a lag. Despite that, 27 basis points, it has already, transferred on the deposit side against 25 basis points. Ultimately, you see, the other thing I mentioned is, certainly, this will have an impact. It will be with a lag. It will happen. This is what we have seen over the past two cycles of both, tightening and easing, that it happens. It happens with a lag of 6 to 9 months. And it will happen, even this time around.
Thank you.
Thank you, sir. I'll request Mr. Laltendu Mishra from the Hindu. Sir, you want to...
If I may, sir, since you had asked earlier to...
There are two more questions.
Oh, I'm so sorry.
Mr. Laltendu, you may please ask your question.
Good afternoon, sir. Sir, we fought a war with Pakistan last month. There is a ceasefire right now. Was there an impact on the economy during this period or after that? Because now both sides have also hardened stance. We are going around the world telling our point of views. And secondly, about COVID, there is some rise in COVID cases. Is there a matter of concern there, sir? Thank you.
COVID is not a matter of concern as of now. I think it has become one of the viruses. Hopefully, it should stay like that. The conflict that we had was, or a skirmish or whatever, you may call it, that had a very, very limited, negligible impact on economic activity. Yes, it did have some impact for those days, especially in northern India, airports being closed, air passenger traffic, did certainly, decrease. But there was no major supply chain disruption, etc. So it does not have any impact, on economic activity, growth, inflation. A few days, the prices in those regions, those sectors had gone up, but it's all normalized. It does not have any major impact on the economy.
Thank you, sir. And lastly, Mr. Aryan from the Informist.
Thank you, sir. This is Aryan from Informist. This question actually is for the Governor as well as for DG Shankar and Gupta. The steeper yield curve has shown to deter rate cut transmission to corporates in the past.
What has deterred?
A steeper yield curve, sir. Now, today is the MPC actions today and the RBI's actions today have steepened this yield curve further. So, are there any steps to curb this? And then secondly, in terms of the liquidity management framework, there have been some discussions in the market. Any timeline on a draft for that coming up, sir? Thank you.
See, liquidity management framework, there is no timeline that we have, but of course we would like to do it as early as possible. These are intricate matters which need to be understood in detail, because actually in our country the money market is not kind of unified. There are three different markets. The participants are different, collateral and non-collateral. So from a transmission perspective, therefore, we need to understand these issues deeper. We have been examining this issue, and I cannot give you a time frame really on this. First, on the yield curves, I'll request, and you can also supplement on the liquidity management framework.
Yeah, as you know, government securities yields are affected by a lot of factors. One of those factors is monetary policy and expectations of monetary policy, and liquidity is another factor. But there are also, it depends on demand in particular sectors and so on. Typically, what you would see is that in response to monetary policy, the short end adjusts quicker than the long end. Therefore, when rates are being cut, the curve tends to steepen. When rates are being raised, the curve tends to flatten. That happens. But the market, over a period of time, these get adjusted. So like we said, we don't target any particular rates in Forex. Similarly, in government securities yields also, there are no rates. Market will find its own level. If market feels it is too steep, compared to what it should be, they would adjust that. So we would leave it to the market for such adjustments. On the liquidity, I think, what the governor said, we are looking at that. Once internal examination is over, we will come out with that framework. Thank you.
Thank you so much.
Thank you, sir. With this, we come to the close of this press conference. I'll thank the top management of Reserve Bank for answering all the questions and making it.
All right. So that was the top brass at the Reserve Bank of India addressing the media, and what a policy it's been. To quickly recap for our viewers, a surprise outsized 50 basis point rate cut accompanied by a 100 basis point cut in the cash reserve ratio. And we also, of course, had the change in stance to neutral, surprising the street completely. Apart from what has been done in the policy, let me also quickly highlight a few things that came out of the press conference. Importantly, the comments on the reports around foreign bank ownership, in private banks, foreign ownership in private banks, where the RBI governor made it very clear there's no rethink on the 74% FDI in banking overall. There is no rethink on the non-resident 15% cap in private bank ownership. And there are exceptional cases which are considered on a case-to-case basis that the RBI will continue to do. Overall, it is reviewing the framework as part of its regular discourse, and that will take a long time before some decision is reached. Secondly, on gold loans, good news for gold loan financiers, because the 75 LTV limit will be actually increased to 85% when it comes to the small ticket loans of up to 2.5 lakh rupees. So that is a positive to watch out for. And lastly, on IndusInd Bank, the deputy governor making it very clear that the matter will settle, and I quote him, very soon, indicating the action that had to be taken by the RBI has been taken. And also responding to a question on the board accountability, saying the MD CEO resigning itself is accountability at the board level and no more action is expected on that front. So those are the three key headlines coming out of the conference, apart of course from the policy. But for now, we're joined by a set of experts to further, go through some of these comments that have come in. Neeraj Gambhir of Axis Bank, Pranjal Bhandari of HSBC, Madhvi Arora of MK Global Financial Services, Rajiv Radhakrishnan of SBI Mutual Fund, and the man of the moment, Soumya Kanti Ghosh of State Bank of India, Chief Economist, the only man on the street to have, predicted a 50 basis point rate cut from the RBI. Mr. Ghosh, let me begin by congratulating you on getting that right, and also on your appointment at, to the Prime Minister's Economic Advisory Council. But on your first take, the 50 basis point cut accompanied by the 100 basis point cut in the cash reserve ratio, what will that do for the economy?
Thank you, Ritu, for the comments. I think, Ritu, there are 2 points in the policy. It's very clear and unambiguous. There has been an unanticipated surprise, of course, in terms of the rate action. But on the rate action, I think it has been front-loaded clearly to aid an investment revival and to lower the cost of borrowings. The second point on the CRR cut, what is most important is that I think the CRR cut has been front-loaded in statement. And it is being cut in September, October, November, December. I think the important point during the CRR cut, where the market actually is thinking about why there has been a CRR cut when the liquidity has been abundant. I think one of the primary reasons of CRR cut could be that it's having a significant impact on the money multiplier. And in an inflation targeting regime, the money supply growth is always endogenous. So if the base money growth is on the smaller side, a higher multiplier actually translates into a larger monetary base. So I think that is one of the thinking which has possibly gone into an CRR cut. And also the second factor is that the CRR cut will have an impact on the MCLR going forward, not now. And that will be actually in the busy season. So overall, while the front-loaded rate cut would now actually cajole the investors in terms of taking up activities which they were thinking of not doing it because of the uncertainty, the action on the liquidity front and the CRR will actually make it happen in the second half when there is the busy season credit policy. So I think this is the overall line of thinking in the RBI, if I am correct.
Well, we take your point there. Neeraj Gambhir, the fact that the stance has been changed to neutral, how is the street reading this? How extended could the pause really be? And is that a bit of a dampener for the bond markets, even with the large rate cut and the CRR cut that we've got?
So the pause can be really extended. Very hard to put a number on it. We'll have to see how the data comes out, particularly on the growth side over the next 2 or 3 quarters. But I think at least 2 to 3 quarters will be on pause, given what Reserve Bank has done now. Market was actually expecting 225 basis point rate cuts between June and August. That has been delivered now, with the possibility of any further rate cuts in the near term over the next 6 months looking very low. Obviously, the longer end of the bond curve has not taken very positively to it. We are seeing yields go up. Initially, they came down, then they have gone up by roughly 4-5 basis points. But I think that's just a immediate reaction. On the contrary, we are also seeing a fairly significant reprice or yields moving down in the shorter end of the curve, both in government bonds as well as in CPs, CDs, and corporate bonds. Corporate bond yields are actually down by roughly anywhere between 10, 15 to 20 basis points across the curve. So I think the benefit is largely being seen currently in the shorter end of the curve, and the curve has steepened. And the benefit is being seen in the corporate spreads, which had widened initially, but now seem to be tightening a little bit.
All right. And Pranjal, your key takeaways and what is now your expectations in terms of this pause and what the terminal repo rate could be?
Yeah. Thank you. A couple of points. One is, I think this was a very clear case of front-loading, as Soumyakanti Ghosh pointed out. Steps that the RBI wanted to do, but didn't want to stagger it over a few months, rather wanted to do it all at once early on. So it's front-loading. Number two, it wanted to give a package. I think, it wants to give liquidity. It wants to lower the cost of funding, but in a way that NIMs are supported. And I think that's where even the CRR made an entry. The third point I would make is that I think we have to now think about what role the RBI wants to play in the state of the economy. And I think there's been a big change here. It's not just about cyclical growth, about trying to tackle growth today or inflation today, but I think they want to affect the medium-term growth of the economy, the potential, the structural growth of the economy. And I think things like cutting the CRR by 100 basis points at a time when it's not a crisis-like situation just basically, talks about that to me, that they want, credit growth to rise in a way that over time for multiple years, credit GDP growth in India is actually raised. In terms of where we go from here, look, my sense is a lot has been done so far. We were thinking terminal rates will be 5.25, but we were not expecting the CRR cut. So now that the CRR cut has come as well, our sense is that, maybe this is good where they are for now. I don't think there's much space to cut rates at this point of time. And I think it's fairly responsible of the governor to reiterate in the presser that, it's a neutral stance. Extra space for more monetary easing at this point of time is limited. Inflation in FY27 will be close to 4.5%. So maybe, giving the signal very loud and clear that at least in this calendar year, there'll be no more rate cuts or liquidity easing.
Yeah, in fact, the Reserve Bank of India governor put it in so many words when he said the MPC finds no space right now to act in the current environment, and hence the change in stance to neutral. But Madhvi, what is your sense on this pause and the terminal rates? And like Pranjal pointed out, perhaps the focus is very much centered on growth now. I think the governor at some point even said 6.5% is good, but the aspiration is 8%. And therefore this, cut in CRR at a time when liquidity is in surplus.
Hi, Ritu. So I think the front loading of rate cuts, I think is a very smart move by the policymakers when they're very certain as to where the macro dynamics are headed, at least in the near term. We may see inflation even going below 3% in the coming months or so. So they're front loaded at a time when there's a global calm. They wouldn't want to really take action at a time when maybe there could be a global chaos, probably 3 or 4 months down the line, where there could be more noise with regard to trade dynamics not really finding a new equilibrium. So I think the decoupling that emerging markets are enjoying from developed markets has been very well optimized by the Reserve Bank of India, especially when they have a clarity with regard to where the macro dynamics are headed, which are still growth supported, supported of a much lower monetary policy rate. Most of us were expecting the policy rates to go below 5.5% in the terminal rate. Our own expectation also was a 5.25. So I think it's a very commendable thing that they have front-loaded at a time when there's supposedly a global calm and supposedly a decoupling on emerging market fronts as far as their policy assessment is concerned, and as far as even their risk-free rates are concerned. Now, secondly, coming on the liquidity aspect of it, I think we've been reiterating in our notes and to our clients as well that we were never of the view that there was an excess liquidity fraud that RBI is infusing in the economy. Insofar, they've done more than 9 lakh crore of primary infusion. Our own math suggests that even if they had to reach a 1.5 or even a 1% of NDTL soft liquidity target that they have sort of indicated in their pressers last time, they still would have to infuse at least 2.5 to 3 lakh crore of new liquidity from the RBI's own book. Of which, I think a large part would now come from CRR. We were expecting more OMOs more towards second half of the year. Now that is sort of taken away. But, if you look at the past transmission cycles as well, be it the Rajan era or Patel era or even pre-2019 rate cuts that we saw, all of them actually saw liquidity surplus being towards a 2% of NDTL or more by the end of the cycle. So there was, I think this time around the surplus is still much lesser than the past cycle. They have obviously front-loaded that, but one has to see that, if you look at the still tepid growth in base money, which again is emanating from the fact that RBI's own balance sheet actually over the last 3 years has barely grown by less than 6-7%, also implies that they had a lot of role to do in terms of expanding their own balance sheet by doing more primary infusion in the form of OMOs, CRR cuts or FX swaps or whatever that takes to basically increase their own balance sheet to ensure that there is a percolation down the base money route. And this is what Soumya was also mentioning, that the role of central bank in infusing primary liquidity was not yet over, and we were expecting them to do more on the infusion bit apart from cutting rates. It was more towards through the end of the year, but I'm very happy that they've actually been much more front-loaded in terms of, using current global calm as an opportunity to actually deliver.
Well, yes, that, 2.5 lakh crore liquidity bazooka from the CRR cut and coupled with the dividend, I think the target of 1% of NDTL surplus liquidity will be more than adequately met. But Rajiv, on the bond market side, we went into this policy expecting a 25 basis point rate cut and accommodative stance. It's turned out quite the opposite. Where do you see the 10-year settling?
Yeah, I think it's an interesting question. In fact, from bond markets perspective, you got a policy repo cut which was higher than what the market had priced in, and you had a 100 basis CRR cut as well, which was unanticipated. But I think the big change has been, or the dampener, if I may were to use that word today, it has been on the stance change, wherein they have gone back to neutral. And effectively, even with the FY26 CPI projection being brought down by 30 basis points, the market possibly could have been looking at the terminal rate being even lower than 5.5. I think that's possibly the dampener from a market perspective, and which is what is getting reflected, at this point on the long end of the curve. But in terms of where you expect the 10-year to eventually settle, I think what needs to, even with a 50 basis rate action, and given that the liquidity surplus is likely to sustain and will be aided by the additional, the CRR reductions that will percolate down to the system. So the effective funding rate will be much lower than 5.5. So you're looking at the effective rate around 5.25 for the foreseeable future. So in that situation, given that we don't really expect any immediate reversal of the policy trajectory, you could possibly see the 10-year benchmark trading lower over the next few months. Possibly closer to 6 is clearly possible in this cycle, given that we really see that surplus liquidity environment to sustain which basically would be reflected in the effective overnight rates, which will stay much lower than the policy rate.
Okay, well, I'm back from the press conference, so if I can squeeze in a couple of questions. Neeraj, do you agree with Rajiv's interpretation? You know, I directly asked the governor, do you want to keep the call rate at the repo rate? He said, we have not made up our mind. So I don't know what you took away from that. Do you expect the call rate to remain at 5/4? And again, the same question that Ritu asked Rajiv. Is there still a bond rally left, or is it over?
So there are two parts to this. One is the intent and second is the mechanics. Let me first answer the mechanics. As long as the system is in surplus and Reserve Bank is not taking out that surplus through, VRRs at the policy rate, you will see call market rates and overnight rates settle towards the STF rate, because that's the only place where banks can park the liquidity. So for Reserve Bank to bring the overnight rate from 5/4 to 5/2, they will have to actively intervene through the VRRs in the system at the policy rate or near the policy rate. So I think that's the decision that they need to take. My guess is that they might not take the decision early on as yet. They might allow this situation to persist so that there is faster transmission. That's what they seem to be wanting. And if the overnight rates stay close to 5/4, then the transmission obviously will be far faster. So I think once they get a sense that transmission is done and the liquidity in the system is doing the job that it is supposed to do, maybe they can steadily bring it back towards the repo rate. But that remains to be seen. So I think it'll evolve over the next, I would say, month or 2 months.
Okay. Well, I got a sense that we have to wait and see. There may be a possibility they will do the repo auctions. He didn't quite say no or yes to it. But again, bond rally, you think it is over? We are at the possibly the lowest point of the yields because it looks like an extended pause. In fact, do you expect another cut at all?
So firstly, I don't expect another cut as yet. I think for the foreseeable future, we'll have to see how the growth pans out. Second, is the bond market rally over? I don't think so. The size of liquidity infusion that is being done, the intent and the front loading of the rate cuts, I think provides a lot of space for the bond market rally to continue. It may not be seen in the 10-year benchmark because all of us tend to focus a lot more on 10-year benchmark. But I think you will see, as I mentioned earlier, that there is steepening of the yield curve that has happened, which means that the front end of the curve has performed a lot better. We are already seeing CP/CD yields come down quite dramatically, and they could potentially come down some bit more. And the corporate bond spreads can actually tighten up from here as well, because they had widened as the government bond yields were actually coming down. So I don't think that if you're seen as a whole, the bond market sort of play is yet done. I think it'll happen over the next 3 or 4 months.
Oh, okay. I wanted to ask Sakshi and Madhavi. Sakshi, first you and then Madhavi. Have you all changed any forecast in terms of where you see the terminal repo rate now and growth forecast for the year? Sakshi? Sorry, Madhavi. Sorry.
Is it for Pranjal or for me? Okay, so as of
I'm
now...
sorry, I meant Madhavi and then Pranjal. Yeah.
Lata, as of now, I think given the fact that they have front-loaded their rate cut and they've given a sense that they would wait and watch, near term, the data is going to be supportive for, a comfortable policy. I don't think near term we are looking at any policy action from the RBI. I think it will also be a function of how the global dynamics play out, because that will be, again, a very important factor in their own reaction function as we go ahead. Near term, I think we will also wait and watch. Our terminal rate otherwise was at 5.25. I think as of now, I'll still wait and watch, because I think they have delivered a lot in the immediate run. And I also believe they would want to wait and watch and see how the transmission really plays out for them. Anyway, the big liquidity bump up is going to come from the Reserve Bank only from September. But before that also, because of the RBI dividend, we'll have ample liquidity in the system. So through the year, we are very comfortable on liquidity, maybe some drying of liquidity towards the end of the year. But generally, we will end the year at around 1.2, 1.3% of NDTL, which is more than the RBI soft target as of now. So I think near term, we'll wait and watch and see. But as of now, I don't think that there will be any rate cut, at least in the next 6 months or so. And plus, a lot will happen globally. I think Gradually, markets are shifting their call on the Fed rate cut as well. We don't know how China's response would be after the 3-month moratorium with the US would end on the trade front. So a lot will also be playing a part. And plus the global bond rout, which is happening, at a very rapid pace. So we'll have to see how that eventually transmits to our economy. As of now, I think emerging market, as I was mentioning, are in a very calm state. So I would just wait and watch rather than pushing for a further rate cut immediately.
Okay. No, I want to know actually whether because of the extraordinary loose policy today, CRR cut and more than expected repo cut, Pranjul, changing any growth forecasts?
Lata, there have been 3 positive surprises on the growth front lately. We've all spoken about weak growth, but there's been positive surprises. One, the reciprocal tariff, at least temporarily was reduced from 26 to 10%. Second, inflation suddenly started falling like a brick, which I think has improved real purchasing power for mass consumption. And third, that liquidity is a lot more looser than anybody had predicted, for the foreseeable future. I think all of this is very positive for growth. All of us who were worrying that growth could be sub 6%, I think that's now behind us. I think growth could be anywhere between 6 to 6.5%. 6.5% for me is potential growth. So, RBI's forecast at 6.5 seems to be, all right at this point of time. So I'm not really worried about growth right now. I'm not worried about inflation too this year. I think, in fact, inflation will be more like 3%. Much lower than the 3.7% that the RBI has forecasted. But my worry about inflation is just in the way we have benefited this year from a high base, next year we will have to live with a low base. And just with the same monthly momentum next year, actually FY27 inflation can easily become 4.5%, again, something that the governor spoke about. So if you think about growth not being that bad, and inflation being perhaps closer to 4 over a 2-year horizon and not much lower, I would say I think we are good right now where we are with the repo rate at 5.5%. I think for me, this is neutral. 4% inflation target plus 1.5% real neutral rate adds up to 5.5% repo rate. I think this is neutral and RBI stance is also neutral. So I feel no real pressure for any changes at this point of time.
Okay. No, actually, I think the governor almost gave it away when he said, this year it is 3.5 or 3.7, but next year it is going above 4. So that almost seemed like a giveaway that, I cannot take this as the base and then go ahead and cut even more. Or at least that seemed to me. Neeraj, do you see loan growth increasing? At the moment, system loan growth is 9%, but with this gush, do we end the year with a much better loan growth? Your bank in particular, even.
Yeah, I don't think we are changing our forecast of loan growth as yet. I think loan growth is not just about the price at which money is available, but also the kind of other dynamics that are playing out, particularly the uncertainty on the global front, etc. So I think the private capex cycle and the demand from consumer side has many other variables to deal with before we can see a sustained uptick. But I would say that with the current action and the cumulative action that Reserve Bank has taken over the last few months, I think the monetary policy has done pretty much what it could for setting the stage for higher levels of loan growth, including the surprise CRR cut, because effectively what the CRR cut does is it allows the banks to create more money with the same amount of base money infusion by RBI. So I think the ground conditions have been set, but nothing much can be done about the global volatility and the overall economic conditions that are playing out. We will need some bit of settlement of that for people to gain the confidence and start thinking about private capex, etc. And that is going to be the key driver for growth.
Yeah, may I just hurry you? Is it fair to say that for the banking system, margins fall in the first half, but rise in the second half because the CRR becomes effective?
Yeah, I mean, not just the CRR, but the transmission of rates into the liability side. I think the asset side will reprice first, and liabilities reprice with the lag. So I think that dynamic will play out.
Okay, all right. I'm being rushed. We have taken a lot of time. Thank you very much, Pranjul, Madhvi, Neeraj and Raji for being with us. Over to you, Ritu.
Well, thank you so much, Lata, for joining us there. And thank you for all of our guests. On that note, we're going to have to wrap up this discussion. Big policy, bigger takeaways, and the guidance ahead as far as the non-policy measures are concerned. We'll continue to analyze them right here on CNBC TV 18. Don't go anywhere. We're back in a moment. But for now, we'll step into a short break.
Stamps 25,000 after RBI front-loads easing to drive growth. Realty, auto and financials lead the charge up, mid-cap index up a little over 1%.
Banking stocks surge after RBI cuts the repo rate by a bigger than expected 50 basis points and doubles up with a 100 basis points CRR cut. Central Bank adds there will be no change on the 74% FDI in banking.
Muthoot Finance and Manappuram Finance gain after RBI announces that loan-to-value for small loans has been revised to 85% from 75% for loans below 2.5 lakhs per borrower, including the interest component.
Real estate stocks surge in trade after RBI cuts repo rates by 50 basis points and CRR to 3% in 4 tranches. The liquidity infusion in the market is likely to spur real estate demand. Well, today's day can be actually divided into 2 halves. One before the RBI meeting, outcome, and the second half as well. We've seen a 300-point recovery as far as the Nifty is concerned from the day's lowest point. We managed to briefly surge past the 25,000 mark as well. And a large leg of this rally is being led by the Nifty Bank. We're seeing over 1,000-point recovery out here, as well as, the growth that we're seeing in the realty pack. Realty space has, spurred up in today's trading session. Look at the gains on Godrej Properties, up almost 6%. Prestige, TLF, all of these counters are doing quite well. Most of the sectoral indices are holding in the green, and the mid-cap end of the market is also doing quite well for itself. Today, it's outperforming the benchmark indices, the advanced decline ratio in favor of the advances. But let's move on to our special segment then, Mid-Cap Movers. We now have Hormaz to take us through the mid-caps that are moving around in trade. Good afternoon, Hormaz. It's a screen that is filled with a lot of green.
Oh, good afternoon, Vamakshi. And as you just mentioned, a tale of 2 halves, if you could categorize it at that. And of course, everything today is about the reactions to the RBI monetary policy, but there are some that are non-policy reactions as well. Some of the gainers in the broader markets. We start off with those. First up, Godrej Industries is one of them, 15% higher now on that stock, and it's at the highest point of the day. The top gainer on the Nifty 500 today. Newland Laboratories is one such gainer as well, 11% higher, continuing to move from strength to strength. And Ramkrishna Forgings has surged up today, and 9.5% higher on that stock on very strong volumes as well. Now moving into policy reactions then, and some of the first movers on that policy reactions were the NBFCs and Chola Investment, 5-star, M&M Financial. Take any BFSI name today and you would find that in the green, 5 to 6% higher for these names. The gold financiers have had a boost as well after the potential relaxations in LTV norms. Muthoot is up 7. Manappuram, of course, in the ban, but of course 5% higher here. And IIFL Finance too, seeing healthy gains in today's session, and that has also had an impact on the real estate names. The realty index had already rallied 5% in anticipation of the policy, and it is continuing to build on to those gains. And look at these names: Godrej Properties, DLF, Ajmera, Oberoi, all of them seeing gains of anywhere between 6 to 7% today. And lastly, some of the volume-led movers, and of course most of them not related to policy though. Root Mobile is up 4.5%, GMDC is up 6.5%, Praj Industries after that contract in Paraguay is up 4%, and Nippon Life too. And a lot of these AMC names, even UTI AMC today has seen some healthy gains on very strong volumes. Back to you guys.
Hormaz, I'm sure today was a challenge to find a single stock in the red for you.
I chose not to.
Keeping it optimistic. Thank you so much, Hormaz, for joining us, giving us a sense of all of the stocks that are doing quite well as far as the broader end of the markets are concerned. Well, we now slip into a short break. The management of Signature Global and Mahindra Lifespace developers join us next to discuss the impact of the RBI slashing its repo rates by 50 basis points and the impact it will have on the realty space.
How you came back to India in 2015, the height of the Maggie crisis.
My father later on told me, when I called him up, I said, "Dad, should I take up this?" So he said, "Son, nobody puts an idiot into a crisis."
Mr. M. Naik of L&T, in his voice, કંઈ નથી થઈ રહ્યું. અને કંઈ થાય બી નહીં ઘણા વર્ષ સુધી.
What is the best piece of advice that you've received?
To get control, you must give up control.
What have been the biggest lessons from a marketing point of view that you would like to leave?
Kodak did not fail because it was a lousy brand. We did a small experiment to have Maggie counters in weddings. A Maggie stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding.
Indian stocks are not cheap. They don't go down because they don't deserve to go down.
The natural thing for everyone is to say that you're doing great and everything's perfect and yes, we agree with everything you said, and they're dangerous.
How difficult and how different is the Gen Z customer?
They don't come in with a reverence for any brand.
Why do you say so?
Welcome back. You're watching Midcap Radar on CNBC TV 18. Just a few stocks that I'd like to highlight from the capital market theme. Look at MCX. That stock has surged by almost 5% today. It is sitting comfortably at 7,450 thereabouts. Over the past 1 month itself, all these capital market stocks have done quite well. MCX, in fact, has gained around 24% and is sitting at an all-time high. Pull up the chart for HDFC, AMC as well. The stock is seeing an uptick of 5% as well. BSE as well, as we've been highlighting all throughout last week, has been doing exceptionally well. In fact, today as well, the stock has managed to reach an all-time high. But let's focus in on a CNBC TV 18 exclusive now. Sources tell CNBC TV 18 that Road Ministry is considering hiking motor third-party premium for FY26. My colleague Yash Jain now joins in with details. Tell us more, Yash.
Well, it's been a long wait for general insurance companies. They've been pushing for this motor third-party premium hike for about 3 years now, wanting to see some hike there in terms of motor third-party insurance premium. And seems like things are moving indeed as far as that particular front is concerned. What we've been given to understand is that Ministry of Road Transport and Highways, that is the Road Ministry, is considering a hike in motor third-party insurance premium for FY26. According to our sources, the ministry has received recommendations from IRDAI, which is suggesting that IRDAI is seeking an average of 18% hike when it comes to the motor third-party insurance premium, with one of the classes, vehicle classes under that, seeking an increase of 20 to 25%. It's a large business segment for all general insurance companies, ICICI Lombard, New India, as well as Go Digit. For the industry, 20% of the total premium comes from motor third-party insurance. Under motor insurance, 60% of the premium comes from motor third party. Now, we've just looked at some numbers. A 20% increase in motor third party insurance premium, if it indeed comes through for FY26, could lead to an improvement of about 4 to 5% when it comes to combined ratios of these general insurance companies, that is ICICI Lombard, Go Digit, as well as New India Assurance. So an important development under works, and we'll have to see how this proceeds. We've been given to understand that in the next 2 to 3 weeks is when the ministry could take a final call on increasing the motor third party premium, after which a consultation paper, the usual process, will be rolled out.
Thank you so much, Yash, for highlighting that extremely important story, especially as far as motor third-party insurance premiums are concerned. Good news if you are a shareholder of these companies, but bad news if you are a car owner or a vehicle owner. Well, moving on, it's not short of news flow today.
Absolutely.
Lots going on. Very important discussion lined up. We have Rajat Kathuria, CEO of Signature Global, and Amit Kumar Sinha, MD and CEO of Mahindra Lifespace Developers, who join us now. Thank you so much, gentlemen, for joining us. I'm sure you're rejoicing given the kind of liquidity gush you've received from Mint Street. Mr. Amit, you've been a regular on the show. First up, decode this particular move for us. What does this mean for a home buyer?
Well, this is a great news for home buyers. In fact, it's great news for consumers all across. I'm hoping the low repo rates will be passed on to consumers by all the banks. That's the key assumption, and that has happened before. So what happens is whenever you have low rates, it stimulates GDP in multiple ways, because people look at EMI coming down, their auto, housing, many of the other consumer durables, the EMI and the outflow comes down significantly, and it stimulates their purchasing, their spending even more. So overall, it's good for the economy. So from a consumer point of view, it's a great news. I heard you talk about the insurance going up. Hopefully, this will counterbalance some of the pain they may have on the insurance side, having a lower EMI. So great news on the consumer side. But on the other side, from a corporate perspective, like as a corporate for us, I think the rates coming down has a huge improvement for us on the balance sheet side. Our debt burden, some of us has a healthy debt to equity ratio, but the liquidity will improve, the interest rates will come down, the interest payout will come down significantly. And that allows us to do more. We can do more capital allocation toward projects that have higher returns. And that same applies to the other industrial clients also. Like I have an industrial business, and many of the clients are looking for expansion. They say when the burden comes down, they'll say, hey, this is an opportunity for us to do more capital allocation, more capex towards growth. So overall, from a consumer point of view, from a corporate point of view, as well as from a industrial investment point of view, this is a great news for all of us.
Well, thank you so much for that, Mr. Sinha. But moving on to then Mr. Kathuria, because you have a very strong presence in the affordable as well as the mid-income segment, and this is one part of the real estate market, especially the lower end of the market, that was not doing so well. Now we've had 3 rate cuts so far this year. How have the earlier 2 rate cuts impacted your demand thus far? And with this rate cut now coming in, how do you see demand panning out going forward?
Yeah, Amakshi, thanks for inviting us to your show. So, I'll start with a very motherhood statement that, real estate is a very capital-hungry sector, and financing cost tends to be very critical either for the developer or for the home buyer. And if you'll see, as a country, we are still at a very nascent stage in terms of supply creation, in the housing space. Top 7 to 8 cities, we are still, after 2 to 3 good years, we are supplying about, let's say, 500,000 new homes as an economy. And if we compare that to, let's say, China, it will be probably doing 10 times more new homes after a fairly long and strong housing cycle. So, there's a lot of work which needs to be done in the space, and all these policy initiatives by the government, whether it is in terms of the earlier rate cuts, tax benefits in the last budget, and this, welcome surprise where it's actually a 50 basis points cut, is a big boost for the customer, which really sees a big impact on their affordability of homes. And I think it very positively impacts all product segments, whether it be affordable, mid-income, and even to that extent, premium housing space. So we are seeing a good, demand scenario in the market. This move should definitely have a positive bearing on it.
Rajat, can you quantify a few numbers for us? A 50 basis point rate cut by the RBI, assuming that transmission is done almost immediately. In terms of EMI burden for the customer, how much does that reduce by? And number 2, Amit did tell us that it improves the balance sheet as far as developers are concerned. So at what rate, would a developer like you, Rajat, actually, borrow from banks? And what will be the kind of positive impact it will have for you?
So as an industry, the balance sheet of multiple developers is much healthier than what it used to be 3 to 4 years ago. So if you look at top 8 or 10 housing companies in the country, if we were doing, I'm giving ballparks here, let's say as an industry, if we were selling about 50,000 crores about 5 years ago, today that number's comfortably jumped to, let's say, 1.5 lakh crores of sales are happening. In addition, there've been a lot of equity infusions into the balance sheets by almost all developers. Net debt or debt levels are significantly lower. So availability of capital is not a challenge. Yes, any reduction in rate definitely reduces the interest burden. But the advantage is more for the consumer because, we fortunately have like a 30-year product available today for the customer. It used to be 25 years, till few years ago, and maybe it used to be 20 years earlier. So 30 years like a long enough product. A 50 basis point cut, does move the needle in terms of the EMI payout.
Well, Mr. Sinha, my next question is for you. You have said that you will be exiting the affordable segment completely over the next 5 years. Given how the rate cuts have panned out, is there probably a rethink or a realignment of strategy for you going forward, or do you largely stick to the same?
So I think it's, first of all, the definition of affordable is very important for us. I think we will go away from the low end of the affordable segment. We'll continue to play the high end of the affordable segment, I think, is what we call mid-premium. We'll continue to play in that segment. And that's a healthy segment as you all have discussed. I think the rate cut will stimulate demand in that segment. So we are excited by it. And I think just to quantify this 0.5%, 50 basis point will have either people keep the same EMI and reduce the duration, but many people will actually see a EMI come down by 3 to 5%, which is a meaningful reduction in the EMI. So that's very good for this segment. So overall, we will probably continue to exit the low end of the affordable segment that we call it, and then focus on mid-premium, premium, which are slightly better for the market we operate in.
Amit, both a qualitative as well as a quantitative question. First up, in past rate cut cycles, typically, when a rate cut of 50 basis points or a 25 basis points, do come about, what has been the subsequent increase in demand? And typically, you said that, most consumers go in for a lower EMI. Do they also go ahead and upscale in terms of the size of apartments or the area that they go ahead and buy?
Yeah, so let me take that question. I think there is, I wish there was a like-to-like correlation, but many times the rate cuts are not always linked to the launches that we have. But generally, what we have seen in the past is when the timing works perfectly, when there's something like this announcement happens and you have launch immediately happening, it just really create a huge amount of footfall for our projects. And as you know, we are focused on 3 major cities, Mumbai, Pune, Bangalore. In case of we had a previous rate cut, we saw a good amount of boost in the footfall for some of our Mumbai projects. So that was very helpful. My sense is that will continue to be there, and people will be very excited to take benefit from the rate cut that they are seeing. The sentiment changed completely. In terms of the upgrade question that you had, I think you are absolutely right. What we are seeing is it's not the per capita income that drives demand in this market in India. It's the per household income. It's not only you are contributing, your parents are contributing. Sometimes, parents, children are contributing. So multi-generational, decision making happens here, and they pull all the investment together. And so when you see that not only more than one person in the family is able to see the benefit of the rate cut, the upgrade desire actually is really can be fructified. So we do see a significant interest in people who say, "Oh, we're looking at a 2-bedroom apartment. Can we go to a 3-bedroom or something like 2-bedroom large?" So we do see an increase in appetite of people to see to explore larger upgrades as we look at it. And for Bombay, that is a huge thing. Go from 800 to 900 to 1,000. That's a big increase, and that helps developers from a ticket size point of view.
So demand is good. There's no complaining about that. This does, boost the sentiment. But Rajat, now coming to you, I just like to understand from you because, when we talk about the real estate cycle as a whole, there are several steps involved, right? You have the land, then you, of course, go ahead with the RERA approvals, and then you go for the launch. So my question is, how long will it take for the affordable inventory to now come in for the industry as a whole, because supply has not come through as much as expected for at least the lower end of the market?
So, we as a company, we started with affordable housing, and we've probably done, in terms of volume, probably the largest number of affordable housing units in the country. In the first 5 years of our initiation, we probably did close to 20,000 units in the affordable category, and this was like absolutely pure affordable, like homes coming in the range of 25 to 30 lakhs. Post 2020, and just to add on, the affordable housing, we used to do it like within the city limits, not going too far away from the city, and hence, calling the project affordable because land prices there tend to be quite low. Over the last 2-3 years, however, there's been a reasonable spike in the land prices in the city limits. At least, in the area we operate, the land prices have gone up, and hence it has made hardcore affordable housing a little unviable for developers. So last couple of years, we've been focusing on mid-income segment. Definitions could vary, but the way Amit was saying that, the upper end of affordable is what they are focusing on. Likewise, we call ourselves more mid-income, but this is a fairly wide spectrum of mid-income, houses starting at about, let's say, 1.5 crores going up to about 4 odd crores. So, that's the spectrum we are playing in. But affordable housing supply is dependent on land cost. And at current land prices, a lot of supply in affordable segment looks tough, at least in the NCR market.
Thank you so much, Amit, as well as Rajat, for joining us, giving us a sense of how exactly the entire real estate space and investors should look at this particular rate cut coming in from the RBI, clearly a positive sign, and the entire real estate pack. Actually, the entire week, in anticipation of a 25 basis point cut, the stocks have rallied. So 50 basis point cut is actually a cherry on the top, and that is what has caused the rally to extend even further. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Rajesh, good to have you with us here. I don't know if you heard the conversation with the SBI chairman, but what's the thing to do? On the back of this rate cut, what would you buy?
Yeah, I think, the last two interviews were really very informative for your viewers. I think they laid out, Mr. Sethi of SBI just laid out the fact that the growth, which was a challenge, is something that they will address by increasing their loan book. And I think that's great for the stock markets as well. And I think, as Mr. Misty also said, the slowdown that we were witnessing in the last year is also getting addressed. Look, I think the challenge for the market was the slowdown in earnings, which was really by way of slowdown in GDP, because the government expenditure, which was really the one which was driving growth in India, was ebbing because we had to control our fiscal deficit. The other components of GDP were not firing. Fortunately, we have a very good deflationary environment. I would say inflation is very benign across several parameters, and that has given us tremendous monetary policy leverage to jumpstart growth. And I think the RBI governor has been courageous enough to go a 50 basis point plus a CRR cut to jumpstart growth. And when we talk to banks, they say that they are ready to lend again in the retail category. So this is going to accelerate growth, which is great for earnings and great for the stock markets. Left to our own devices, I would not be surprised if India goes to a new high. As far as your sector call is concerned, of course, look, I think the immediate beneficiaries of the interest rate cut are NBFCs. You have seen this is a very strong market. Look at how real estate, capital market plays, engineering companies have bounced back. As an aside, I would say it's probably automobile companies also, which have not participated so far, could also be beneficiaries as you move forward.
So incremental money, when you have to put it to work at this juncture, it would be NBFCs and auto?
So my incremental money has gone into NBFCs. It has gone into auto. It did go into quick commerce companies, and I bought some public sector banks. So that is really where my incremental money has gone. I rue the fact that I have not bought enough real estate or capital marketplace, but I think those are also sectors which can do well as you move forward, given what has happened.
You want to name any names, especially in NBFCs, Rajesh?
You know the challenges that we face, but I have added a gold finance company where a private equity major has taken a stake because it was available at a one-time price to book multiple. So that is something that I've added as far as NBFC is concerned. Of course, we have other NBFCs as well. We continue to like the fast-growing NBFC, which had become extremely expensive, only to become slightly more cheaper over the years as the price consolidated. We think it's catering to the right consumer segment, and it can kind of continue to grow as you move forward. So that's another large holding of NBFC that we have.
Real estate was a missed opportunity in some way. That's what you said. Now, would you look to add to real estate, or it's too late?
So not my money incrementally is not going to real estate. Honestly, like I said, it was a missed opportunity. But when we speak to real estate companies, they are very excited about their pre-sales that they are witnessing. We asked them about whether they are seeing any slowdown given the stock market decline, etc. They were, quite affirmative that they are not seeing any slowdown. So even though they are hearing of an economic slowdown and a stock market slowdown, they are not seeing any pre-sales slowdown. And given this boost that you're going to get from for the economy, I think it's going to be a sector which is going to remain elevated. But for me, my margin of safety is a little low as far as real estate companies are concerned.
Yeah, no, absolutely. The other one is defense sector. By the way, the defense index, we've forgotten about it. It's down. The index is down after a huge amount of outperformance. Do you own anything here, Rajesh?
Yeah.
And the question is it? Are these viable now at these levels?
So again, I own only the frontline companies. But I can tell you, we were in a defense conference, and the kind of visibility that these companies are talking about, growth rates, etc., they seem to be full for a 5 or 10 year kind of a period. They kind of are alluding to the fact that they can actually grow for a very long period of time. But I think you've kind of hit the nail on the head. Are these at valuations which are comfortable? But look, I think that's the challenge for our equity market. There's just too much money chasing these growth stories. I mean, look, I've been to like 5 or 6 conferences in the last month or so. When you talk to electronic manufacturing companies, engineering companies, right, defense companies, the confidence for growth rate for 5 or 10 years is incredibly high. But these stocks are also not cheap. So that's really the challenge that we have. So India is in a very good spot. The risk will be only global. Our macros are very strong, and I think we are again poised to accelerate as we move forward.
No, absolutely. Another sector, Rajesh, like defense, where, you're asking the question of what's going on with the market caps, which have ballooned, right, is rail. And we're going to focus on that. Nimesh actually is now joining us. Nimesh is going to talk about, not rail now, but rail later in about 30 minutes time on Editors Roundtable. Nimesh, but for now, what's the chatter? What are you picking up? What's the mood like?
Well, Prashant, it's all about RBI policy, right? And we've seen a big rally in the financial stocks. So the Bank Nifty is up 1.5%. The top gainers in the FNO are all part of the financial names, whether it's NBFCs or private banks. So actually, it's come as a big surprise. The whole policy was much more than what the street was anticipating, especially in the CRR. Nobody was anticipating such a big cut coming in. So that's been a big talking point in the daily rooms as well. And we've seen a reaction across the financials and rate sensitive. So I spoke about buying interest in the bank names and small private banks and NBFCs. Even the real estate, which was seeing a bit of profit booking yesterday, have again seen a big rally today. So all the real estate stocks are buzzing in trade and on large volumes as well. I guess from a technical point of view, 24,950 is the level on a closing basis to watch out for. If that's the case today, you might see further short covering rally in the days to come. So clearly, the RBI policy was the center stage today and has led to a big rally across the financial names.
What are you picking up in terms of specific stocks, Nimesh?
So the first stock on my list today, Prashant, is Ramkrishna Forging. That stock is buzzing in trade, up 10% for a couple of reasons. One, I understand there was a selling going on from a domestic mutual fund. That seems to be largely over. So supply is gone. And also the fact that the promoters, earlier this week, announced putting in money at 2,100 rupees per share. The question mark there was on the warrant by when they will convert. The sense I'm getting from the investors or some of the buy-side fund managers is that maybe that money will come much before the 18 months of the warrant period. So I guess that's also a bit of the reason why we're seeing a bit of traction in that name today. So that's the first stock. Second stock is Azad Engineering, which we highlighted a large block in the morning trade, nearly 8% equity got changed hands. Again, I understand the promoter entity was a seller in today's block, and that's the reason why that stock is under pressure, because the entire deal happened at a much discount. The third name is ITC. This is going to be interesting. Well, the stock has been consolidating off late. I understand some couple of large, global FIs have bought also ITC in the last few weeks. But for ITC, the sense I'm taking is there could be a corporate development very soon, and that is potentially an inorganic move by the company in the foods business. So that's the buzz as far as ITC is concerned. And the last one is Elecon Engineering. Again, something I ended up putting out at least one stock where there's a large block coming in, and the next could be in Elecon Engineering. So while the stock has been consolidating, the sense is that could be a large block coming in Elecon very soon.
Swiggy, and there's the other one, right, which has been moving around. So RK Forgings is, of course, is the biggest volume-led gainer, by the way, right now. Azad Engineering, Elecon, and ITC are some of the names which Nimesh is highlighting. We'll keep an eye on these stocks. Well, we'll take a break here, but as we do that, let's just sort of revisit that story, which is, of course, the big talking point globally, the fight between President Trump and Elon Musk. The question I asked Leif Eskesen, chief economist at CLSA, is this. Can this fight lead to a toning down of the trade war rhetoric? Can this actually, at the margin, be a net positive in that regard? Listen and take that break. See you on the other side.
The more voices you have from corporate titans, right, that are pushing back at this sort of more aggressive tariff strategy, right, and a warning about the broader macroeconomic implications, but also the sector implications of these tariffs, right? The more people you have from that side of the spectrum talking out against that, it could, on the margin, as I said, soften the stance of the Trump administration in their negotiations with other parties, right? But I also think the sort of, should we say, the tariff strategy as an ideology runs deep in the Republican Party with Trump and with other advisors as well, right? So I don't think it's going to lead to a U-turn on that front, but maybe a somewhat more, should we say, constructive dialogue in the ongoing negotiations with other trading partners, right? So again, on the margin, it could soften the stance a little bit, maybe move us on the margin a bit more forward on some of these trade negotiations, right? But again, it's not going to stop them. It's not going to reverse them, but it could sort of add a little bit of reality check to the ongoing debates.